Good evening, everyone. Thank you for joining. I like that only milk talk. Well, never fear, the milkman is here. Please take a moment to read the disclaimer I put up. I am not an investment professional. I'm not an investment advisor. I just do a lot of research. Please take everything I say with a grain of salt and use this for research and educational purposes only. Now that we got that out of the way, Chris did say that he was going to be here. I'm not sure where he is. He's running late. That's fine. We're going to start off with a moment for investment psychology. Since I wasn't able to stay on the market close, I had a lot of phone calls come in. So just want to discuss real quick that people should take a step back and think about where we are in the market cycle. So NVIDIA Super Bowl is Wednesday. Earnings, who knows what's going to happen? The reality is that shares of NVIDIA have declined by just over 12%. The reason my head is tilted is because I have a huge screen in front of me. I'm looking at some numbers. It's gone from $212.19 down to $186.60. Shares have retraced by just over $25, and they've retraced by just over 12% in a short period of time. In the same amount of time, market's been choppy. S&P's been down a little bit. We've had some really volatile swings. NASDAQ's down. I'm going to let you in on how I look at things. I'm not going to say the three words. We're not going to turn this into a drinking game, but they may come out of my mouth in a little bit. But maybe I should bring up a chart. I think we should bring up a chart. Let's do that. Let's go to Seeking Alpha. Let's bring up a chart, take a step back, and give everybody some ideas. So SoFi is another good example. It's down from 32.73 to 27.04. So let's do the math on that real quick. So companies like SoFi are down 17.4% in the past couple of weeks. For a lot of people, that's not fun. For a lot of people, you got used to seeing a bigger number in your investment account than you previously did, and now it's showing a smaller number. This is how I deal with it, okay? On a 5-day basis, this is an ugly chart. SoFi's down 15%. But on a month basis, it's still up 2%. Now, Matty Money, everything to zero. That's right, everything to zero, Matt Money. But on a year-to-date basis, SoFi is still up 75.58%. So, sure, the market's been really choppy over the past couple of days and the past couple of weeks. But there's a lot of people that were averaging down at 15. If you were buying in at 15, is there really anything to complain about being at 27? No. Let's look at the SPY, okay? Past 5 days, the S&P is down 2.8%. But if we go out a month, it's still up a little bit. 6 months, it's up almost 12%. In the past 6 months, it's gone up the annual average pretty much. Year-to-date basis, the S&P is still above the annual average. So is there really a lot to worry about at the moment? Depends what you're invested in. I mean, look, the money that I put into the market, I consider gone. I absolutely consider gone because you don't know what's going to happen if you're investing in individual equities. With an index, you can handicap it a little bit easier because you truly have long-term trends to look at. But you take a company like Oklo, which, look, I have no idea why it's up this much. But when you look at this on a 5-day basis, it's down 13%. 1 month, 42% this company is down. 1 month, 42%. But it's still up over 300% on a year-to-date basis. So, yeah, if you bought it at the top, you're not feeling good. But if you bought anywhere over here, you're still outperforming years and years and years and years of growth on the SPY. So I think everybody needs to take a step back and take everything with a grain of salt. I have a feeling on what is going on, and I think a lot of people are over leveraged. And this is why I do not use margin. I've never used margin, and I don't plan on ever using margin. I have margin turned on because for level 2 options, you have to have margin turned on. I dislike that because if I have the capital to use on my own, I should not have to turn margin on. There are a lot of people probably on margin, and a lot of people that probably got caught up when the market was in an upcycle, got overexcited, decided to go on margin, and now they're feeling pain. And look, the market could go down further. It could absolutely go down further. We could see a scenario where people are forced to liquidate positions because they are declining and they're on margin. They're going to get called. They're going to get stopped out of their positions, and they're going to have to sell into weakness, and that could over dramatify this market. Could absolutely happen, but that's a short-term thing. Whether it happens over a week, a month, 6 months, a year, I couldn't tell you. That's why I stay diversified myself. And the reason I say, and I can continue to say with confidence that I don't care, is because I can outweight this. It's because I'm not on margin. And it's because I have a good amount of capital tied up in index funds. And that helps offset my losses. So take everything with a grain of salt with this. And I really hope people are not freaking out that much and they have positioned themselves where this type of volatility does not absolutely shatter the account. So we'll see what happens. I am really excited for Wednesday. I did not get a chance to watch any videos on CNBC. The only stuff I caught was when I drove into the office this morning. I had it playing on my phone. So I want to look at NVIDIA. Look, we all know that this is the Super Bowl of earnings, okay? I'm actually going to turn the comments off for a few minutes because you guys are great. Thank you for being here, but I want to get this out and not go off on a tangent by stuff that I say. So look, NVIDIA had an incredible quarter, absolutely incredible. And yes, I'm starting to grow a mustache. We'll see what actually happens. So we'll just put that out there. So last quarter, NVIDIA delivered an incredible quarter, all right? 56% year-over-year growth, 6% sequential quarter-over-quarter growth with $46.74 billion in revenue generated. This is a monster. We know it's a monster, and it looks like it's going to continue to be a monster. There are not many companies that put up 56% growth, let alone companies that generate the amount of revenue that NVIDIA generates, putting up 56% year-over-year growth. On a net income basis, their net income grew 59% year-over-year, $26.4 billion. It's incredible. Now, their gross margin, 72 to 73%. Pretty amazing. Data centers was 85% of revenue, came in at $41.1 billion, up 56% year over year. Now, NVIDIA has run a lot. Their guidance for Q3, and I had the NVIDIA slide deck up. Hold on. Let me bring it up. I ended up closing the wrong. This is what happens when you have too many things open, everyone. You end up closing stuff by accident. Let me bring up the presentation. Let me share the presentation. Boom. I'm getting better at these transitions, everyone. I promise you I'm getting better at these transitions. Where was their guidance? Here we go. So they're expecting 54 billion plus or minus 2%, and that does not assume any H20 shipments to China. Gross margins of over 70%, which is absolutely insane for a hardware company. Operating expenses, $5.9 billion, fine. 16.5% tax rate, fine. I mean, this is pretty amazing, okay? I still think that there's going to be a very big spend with NVIDIA. Now, we know Jensen has openly talked about 500 billion plus in GPU revenue through 2026 from Blackwell and Rubin platforms. We know that the hyperscalers continue to buy NVIDIA chips and their CapEx continues to go up. I will bring a chart of that. So NVIDIA needs to crush, and they need to crush for a few reasons. We're in an environment where the market is very choppy. If NVIDIA doesn't blow earnings out, or if they don't have more than 50% year-over-year growth, I do have a feeling that it's going to be the sell the news moment. Even if a sell the news moment happens, I won't be worried because of the run NVIDIA has had. And I still think it's a company that is very fairly valued and there's still upside potential in it. So I think this is going to be very interesting. I want to hear what Dan Ives had to say today and a couple of other people. So before I start getting into CapEx and why AI is not a bubble and all that other stuff, let me bring up the CNBC interview I was looking for. Let's get this going. Give me a moment. Let me stop sharing that. We are not going to make a rookie mistake. We are going to share the audio. Absolutely sharing the audio.
Maybe of the year are NVIDIA's earnings. They're out Wednesday afternoon, and to say they are a big deal is an understatement. So we brought on two big deals to talk about it. Gene Munster, managing partner, Deepwater Asset Management, Dan Ives.
Oh, we're getting a 2-for-1 with this. Now, I apologize to anybody that's seen this. I have not seen this. I actually like listening to Gene Munster also, so this is going to be very interesting.
Global head of technology research at Wedbush Securities, both coordinating and rocking some pink today, by the way. So appreciate that. No, it's my race car helmet is pink.
I think Gene wearing pink's bullish.
Yeah, this is a big deal for me.
Usually pink is now the bullish color. Let's talk about this, Dan Ives. How big are NVIDIA's earnings on Wednesday night?
It's a Super Bowl, not just for tech earnings, but I think this market, right? I mean, the reality is that there's only one godfather of AI, and that's Jensen. And NVIDIA, look, it's the foundation in terms of what demand looks like, in terms of what we're seeing. And, you know, Gene and I talk about it often. I think it's going to be actually a huge positive growth catalyst that we see, not just for NVIDIA, but for tech stocks. But it all comes down to on Wednesday night, you're going to be able to hear a pin drop on trading floors around the world.
I just don't know, Gene, how you even plan for
a pin drop. Did Ives really just say that we're going to hear a pin drop on the trading floor? I mean, man, he's really bullish.
This normally, you know, you've got the analyst estimates, you've got a little bit of a whisper number. If they kind of come in a little bit above it, it's good news. Everybody knows NVIDIA's numbers are going to be gigantic. Is that a fair statement?
Yeah, it's not only a fair statement. Back on the 28th, Jensen went at the GTC. He basically gave us the playbook through the end of next year. He said this $500 billion in Blackwell and Rubin revenue. If you take that for his word that they're going to be able to do that now, if they can get supply, that implies a 54% revenue growth rate for next year. The street's at 41%. Now it's come up from 34 to 41, but that's the gap. As I think about this, Brian, that's the gap between where they've set the bar on the 28th.
He gave us 54% revenue growth. I don't know a lot about Wall Street, except I do know this. 54% ain't going to do it when it comes to the stock, is it? It's going to have to be better than 54%, isn't it?
All right, I got an issue with that. I have an issue with thinking that it needs to be more than 54%. And I know that I said I'm expecting more than 50% growth, and it could be a sell the news moment. And I do think it's going to be a sell the news moment. But this is a $4.5 trillion company. To think that they're going to continuously grow revenue by 50% is crazy. That's just, it's not realistic. They maybe have one or two more quarters of this, and I think it is going to be a much tougher job to increase revenue by 50%.
I don't think it needs to be better than 54 this week. I think it needs to be better than the 41 where the street's at.
Yep. And to Gene's point, look, we just getting back from Asia, being there 3 weeks. Demand to supply for NVIDIA chips is 12 to 1. So it comes down to there's one chip.
12 people want to order for every one potential chip that
Exactly.
exists to order.
So there's one chip in the world fueling the AI revolution. And that's why it speaks to our view that anyone that talks, and Gene and I talk about it all the time, anyone talks about an AI bubble here, we are in the third inning of where this is all playing out. And I think that's why this is an inflection point. You're going to see ultimately what the demand looks like from Jensen himself. And I view it as a bullish catalyst for tech stocks.
Here's the worry, though. Again, not a tech expert like you guys, but I do know also that technology changes, it evolves. And I think, Gene, if I was, now I guess I have to play the role of the bear-ish, right?
Mm-hmm.
If I was going to be the bear, I would say that what if somebody else comes out with a much better chip and all of a sudden NVIDIA's chips aren't as good as they are right now?
So let's just.
Well, that's I just don't think that's simply even in the equation, or at least over the next 6 quarters. But to your point, maybe 2-3 years down the road. And that's, I think, probably the biggest takeaway that your viewers should glean from this week is that we're still early in AI. Now, the companies that benefit from that will change over time. They'll kind of have 2-3 year chapters of growth rate. But I think that the undeniable truth here is that we have just scratched the surface in terms of where this is all going. And when I hear talk about Peter Thiel selling or SoftBank selling NVIDIA stock, I think it lands on something where they've made some money, but I think ultimately we're still so early, and there's going to be a lot of companies that are going to benefit from this over the next several years.
All right. So Dan Ives saying we're in the third inning. Apologize for that. I obviously don't know how to work multiple tabs. Apologize. I think we're 1989, not 1999. Clearly, from what I've been putting out on X, I think that this is a scenario where we're so early in the AI revolution. I mean, we're still seeing advancements in cloud, and cloud has been out for more than a decade. So this is very early. Are we going to have peaks and valleys? Are we going to have retracements? Absolutely. That doesn't mean that we're in 1999. I hate when people say that. And the fact that Gene Munster said 6 quarters or more of NVIDIA chip dominance, I am a little surprised. I thought he would have said something longer run rate on that. Now, we'll see. I don't think that anybody is really going to be able to touch these chips. So who knows? I think the most important thing at this point is that Ives is saying for every 12 chips being sold in this, only one is a non-NVIDIA chip. I don't know if that's true or not. Got to take him at face value. I don't have that data. He travels around the world, talks to everybody. So hopefully that's very close to the true statistics. I don't see that it wouldn't be. I would not be surprised because there's really nobody else in the game. Now, a lot of people would say, well, Steve, what about, or Milkman, what about the custom silicon that Amazon is generating, that Alphabet is generating? A lot of that is to optimize their workloads on cloud. It's not necessarily for the same stuff that they would be getting the NVIDIA GPUs. And they're all still buying more and more NVIDIA GPUs. So I'm pretty excited about Wednesday. And here's some of the stuff that I think is important to look at. So we know Taiwan Semiconductor has reported. So let's look at their financials. Let me bring it up real quick. I want to look at it on a quarterly basis. So on a year-over-year basis, they've added, call it $9 billion or so, $8.5 billion in revenue, which would be, what is that, like 35% year over year? I mean, that's pretty impressive. Big quarter. It's the most revenue they've ever done in a quarter. Got a little bit of quarter-over-quarter growth. And the fact that they grew quarter-over-quarter is impressive. This to me means that NVIDIA spent more money than they did the prior quarter with them. And we know where the CapEx went. So let's bring that up real quick because this is something that is very telling. And maybe I'll get into the AI rant. I don't know if I really want to take up all the time. I'm certainly not reading the entire freaking article that I wrote. Why does that look like that? Hold on. I'll try to make it so everybody can see it. What is going on here? We'll try to share another way. Hold on. Let's just share by the tab. I guess no matter how I share it, it's not going to look great. I apologize. Oh, it looks a little better now. Okay. So this is the CapEx spend, everyone. So in 2024, the combination of Meta, Google, Microsoft, and Amazon, and yes, I do know that Google's parent company is Alphabet, so don't roast me for that. They spent $217 billion on CapEx. In the trailing 12, they've spent $330 billion, a 52% year-over-year increase. And based on the 4 conference calls, these are the numbers that they are expecting to spend throughout the year, throughout this fiscal year. Now, the reason I have a lower number for 2025 than the TTM for Microsoft is because Microsoft's fiscal year ends in June. They've already reported Q1. That's why this number is bigger. I put what Microsoft did to be very accurate for the 2025 fiscal year. Amazon, Alphabet, and Meta, this is their top end range of what they say they're going to do for 2025. If they do that, these 4 companies alone will have spent $354 billion in CapEx, 63% more on a year-over-year basis than 2024. This is what the chart looks like. And these companies are not taking their feet off the gas pedal. In fact, they're slamming it down and they're spending more. They have all come out and said that they need to spend more money. Now, that is very bullish for NVIDIA. I can't handicap what the growth rates are going to be next year. Seeking Alpha has done a very good job of getting all the analyst updates for the next couple of years. I will bring that up in a moment. I do want to bring up what the valuation looks like. Let's make this a little smaller. All right, so everybody can see this. This is where NVIDIA is. Let's highlight this. Get a little highlight on there. So right now at $186 a share, NVIDIA is expected to do $4.52 of EPS this year. They are expected to do $8.09 in 2027. That means that they are trading at 23 times 2027 earnings and that they're going to do 79% in EPS growth over the next 2 years. These are the street's numbers, not mine. This does not look like a company that is expensive by any means. This does not look like a company that's overvalued to me. And when I look at the largest companies in the world, I compare them to Coca-Cola, I compare them to Costco, I compare them to Walmart. And when I say large, I mean big tech. This does not look like a market that's expensive to me. And this is why I can keep a cool head and say I don't care, because I'm not in Oklo. I'm not in SMR. I'm not in these companies that are retracing hard, nor do I care about them. Because guess what? They go away tomorrow. They're not on the S&P. They're not on the total market indexes. The market won't care. I am in most of big tech. The only one I don't own is Microsoft, and I'm probably going to start a position this week or next week. I need to get into Microsoft. I think Microsoft is a phenomenal company, and it's a very attractive valuation right now, in my opinion, So the little bit of downturn has made me think that this is an entry point that's good for me. May not be good for anybody else, but it's an entry point that I like for me. NVIDIA, I wouldn't be surprised if it goes to 200 or 160 on Wednesday. I certainly don't think it's just going to tread water. We need to see what the numbers are like. And more importantly, we need to see what the forward forecast is like. But once again, I think we're in the early innings of AI. And I certainly don't think AI is a bubble. I mean, I'm not even going to put a poll up. I really don't want to go down that road right now, but I will if people want me to. I will put up the post that I did. It was around 2,200 words. Seemed to be some good feedback on it. Some people thought I was crazy, which maybe I am for writing this much on an X post. So hold on. Let me link it in the chat. So here it is. If you want to read it, read it. It's I think it was interesting. It's certainly a topic that's at the top of a lot of people's minds. So it got a bunch of traction. But I don't think that we're in an AI bubble. This is not the 90s. This is not company. Oh man, I guess I'm going to go down that road. I'm going to stop myself. We're not going to go down that road. I want to talk about BM&R first, and then we'll consider going down this road. A lot of people are down on BM&R. Okay. I get it. It sucks. It absolutely sucks. But is the investment thesis gone? That's the real question. Is the investment thesis gone? So BM&R is at $30.95 today. A lot of people do not feel good. A lot of people have put a bunch of money in this. They may have gone leveraged. Everybody knows that crypto is volatile, which means BM&R is going to be volatile. Now, I'm not going to look at a 52-week range because it's spiking to 161 was crazy. But at the beginning of October, it did hit 63.22. So right now, in a month and a half, BM&R has retraced exactly. Big retracement, everybody. 51%. 51% this company has retraced. Now, Tom Lee was on CNBC. I want to listen to what he has to say, but I'm going to tell you what I think first. And I'm going to give you the cool-headed, level-headed response from a position of I don't give a fuck. Because I don't give a fuck. If I liked it at 55, and if I liked it at 45, I like it at 35. Because my investment thesis has not changed. I am still buying. Now, I'm buying. That does not mean you should buy. I'm buying it with money that if it goes away, it goes away. And it would suck, but it's not going to impact me because I don't go crazy and I'm not on leverage. I also have a very diversified portfolio. And unlike Matt, who full ported, I will never full port on something. Now, here is the very quick synopsis before we listen to Tom Lee. My thesis was Ethereum is very volatile, and I do not know what the hell is going to happen. When I look at the chart, and I am not a technical analysis person, and I do need to talk to Asian Steve and have some people teach me some TA. So Dougie's going to try to teach me. Maybe Asian Steve will teach me. Who knows? I need to get better at TA. But be that as it may, Ethereum has had some very big drawdowns over the past 5 years. To think that that would never happen again is crazy. And if you're bullish on Ethereum at 42, 43, 4,400 last month, and you're scared at 3,100 this month when nothing has changed, to me, that's crazy. That's absolutely crazy. So, we haven't even really begun to see the stablecoin expansion right now. And my thesis revolves around stablecoins. Every CEO is talking about stablecoins. JP Morgan with Jamie Dimon is talking about stablecoins. Of all banks, The one that was against crypto, crypto's a scam, blah, 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 JP Morgan. Now you got Noto, Q1, stablecoin, SoFi. We know PayPal, we know Shopify, we know MasterCard is built on Ethereum layer 2. For me, this was always a several year investment. And I am planning on buying more Ethereum directly and BMNR next week. I am planning on buying in December, and I am planning on buying in the new year. And I'm looking at this as, if it just kept going up, that would have been great, but that's not realistic. And I have to protect myself and know that I am not smart enough to be able to call when something is just going to go up. And I can't call top. I certainly can't call a bottom. So I will average my way into it, good or bad, better or worse. And right now I'm getting a much better price than I was. And eventually it'll even itself out because I'm not margin, not leveraged, and I have time on my side. And I do think that once we get a lot of stablecoin adoption, and if tokenization becomes real, it will turn this into a deflationary asset, which should make Ethereum go up and should make BMNR go up. So for right now, I'm really not that worried. I just think that a lot of people need to take a step back and really think about how they're positioning themselves and make sure you can sleep at night and make sure you're not doing anything reckless, because going all in on anything, whether it's Apple or BMNR, to me is not a great idea because you leave yourself exposed. You never know what something's going to do. I mean, that's my 2 cents. Let me play this. I'm interested in Tom Lee. I know a lot of people are pissed at him right now. He's been very right. And in the short term, who cares? So, all right. So we're going to address this right now. So my argument makes no sense. You won't buy leveraged stocks, but yet you buy BMNR, which is a levered crypto play. Okay. There's a reason I've been buying BMNR in addition to Ethereum. I am not allowed to stake in the state that I am in, nor can I stake through DeFi or restake. I believe that BMNR is going to be in a position where they're going to be able to do a lot of things that I cannot do personally. They're going to be able to generate a lot of revenue that becomes net income, which is accretive to EPS, through their ability to stake those 3 different ways. They're also going to become a huge network validator and generate capital that way also. And I think that they're going to get a good multiple on the MNAV. And that's why I'm in BMNR in addition to Ethereum. I'm not choosing one over the other. I'm choosing both. So I really wanted them to have an earnings call because I wanted to know why they weren't staking yet. Now, there's been rumors that they're going to start staking soon. To me, they can't stake soon enough. So look, here's the other thing. If BMNR keeps going lower, I'm happily going to buy more. Ethereum keeps going lower, I'm going to happily buy more. Because for me, the long-term thesis hasn't changed. So that's all there is to it. Let's watch the video. Let's see what Tom Lee has to say. Really interested in this.
Broadly, with your kind of high-level view here, what do you think is really going on? Tom, let's start with you first.
Well, Leslie, I think the markets are a bit nervous in crypto land, in equity world, because one, we've had a government shutdown, and then there's been doubts about AI valuations and people raising questions about that. So AI stocks have corrected and many growth stocks have corrected. And then in crypto specifically, it's been dealing with two issues. One is there was this big liquidation event on October 10th, one that really was a larger liquidation event than anything seen in history. And the second is because crypto is risk on, I think markets are really struggling with what the Fed's going to signal on December, because, you know, if you end up with a hawkish Fed, it gets crypto investors very nervous. I think that's all creating this downside pressure. But I think the good news is there are signs of exhaustion. I did speak with Tom DeMark of DeMark Analytics, and he thinks there are signs that would look like a bottom that could be occurring sometime this week.
Sometime this week. Tom Lee's looking at a different bingo card than me. I sure as hell don't know that it's going to bottom this week. Hopefully he's right.
Matt, do you agree with Tom here?
I actually do exactly agree with Tom. I think we're nearing a bottom. I look at this as a great buying opportunity for long-term investors. Bitcoin was the first thing to turn over before this broader market pullback. It was sort of the canary in the coal mine, signaling that there was some risk in all sorts of risk on assets. I think it'll be the first thing to bottom. And I agree with Tom, we're getting very close to that point. So I think it's an exciting opportunity, again, for people who are looking out a year or more into the future.
Tom, kind of digging into Ethereum a bit more, what do you think are some of the idiosyncratic drivers here? Are there things that you think may be due for more of a decoupling from just the broader risk environment or crypto as well?
Well, Ethereum is a smart contract platform, so it differs from Bitcoin, which is a store of value. And in many ways, its virtue is that it's inert, and it represents digital gold and a good store of value. Ethereum, on the other hand, is because it's a smart contract platform, is really the rails where I think a lot of things are going to be built. And one of the big breakouts this year has been stable coins, but it's also been things like prediction markets, and now talk about tokenizing more than just dollars, but equities and real estate and alternative assets and other assets. And a lot of that will be built on Ethereum or layer 2. So I think from a perspective of what the ecosystem looks like, Ethereum is a place where there's a lot of activity taking place, and you can measure it by transaction volumes or transactions per second, or even value locked on the chain. And these are all rising. So to us, I think it's a story that still is in the earliest stages, and one of the reasons we consider it a super cycle.
And Matt, you agreed. You said that you agree with Tom that it's nearing a bottom. How much of a long-term buy do you think this is?
I think it's a generational opportunity for long-term investors, whether you're looking at Bitcoin, Ethereum, or Solana. To double down on what Tom said about Ethereum specifically, look, I think investors are very nervous broadly about the economy, about AI valuations, about tariffs, about the broad economy. You want to look for secular trends that are decoupled from that. I think regardless of what happens on the economy in the next year, stable coins will grow tremendously. I think regardless of what happens, tokenization will, maybe 10x in the next few years. Prediction markets are going to be huge. Decentralized identity and digital identity are going to be huge. Ethereum lets you play those secular trends, which are in this enormous growth phase, almost regardless of what's happening in the broader economy. So for me, it's really it's a generational opportunity, and to get in at these prices, I think really is almost a gift for long-term investors. It's a tremendous opportunity.
Tom, in terms of just the overall volatility, what are some of the near-term headwinds you're expecting Ethereum to face?
Well, one of them is the industry did suffer a big liquidation event that I think crippled many players and wiped out many accounts. So I think that this, just like in 2022 or in 2020, it does take a few weeks for the industry to sort of find its footing. And I think that's why crypto prices have lagged here. And it does have the signs of that maybe a market maker or two actually is unable to provide market liquidity. And as you know, as liquidity contracts, it's the same thing as the central bank tightening. So it's almost like crypto QT. I think the other thing the markets are grappling with is people talking about the 4-year cycle. Many are convinced that Bitcoin prices have peaked. So in some ways, Bitcoin being the blue chip and the bellwether is important for crypto, because if Bitcoin makes a new high this year, then it really obviates the fact that there is a 4-year cycle. And so it's, to me, between now and year end, I'm pretty bullish on stocks. This sort of weakness in the first half of November was what we expected. But as markets rally, I think that's going to help propel Bitcoin to an all-time high.
Tom, we can't let you go without asking about granny shots. That ETF recently celebrating its 1-year anniversary, gathering 3.6 billion in assets in its first year. You plan to expand the lineup. How do you plan to do so, and where else on the court will you be shooting from, so to speak?
Yeah, well, that's right. Granny shots, which refers to a way of shooting free throws, proved to be very popular with investors, as you point out. Um, and part of it is the performance. Granny shots in its first year outperformed the broader index by 1,000 basis points, and year to date beating the S&P by more than 1,000 basis points. The idea of granny shots is the idea that there are super cycles, themes that last for more than 5 to 10 years, and we want to buy the strongest stocks. So we are expanding the granny shots family. That they're going to go effective tomorrow. One is a mid-cap granny. So this is taking the same granny model, finding the 7 super cycle themes, but buying small and mid-cap stocks. And it's going to hold more names, maybe 40 to 50 names versus 30 for granny. And this is going to be a good way for investors to get additional granny exposure in small and mid. And the second is an income-oriented granny shots product. So this is going to be using the same granny shots model, but also generating income. So the tickers are GRNJ for small mid cap and GRNI for the granny income.
Okay, now I have some questions. The Granny Income Fund, is he now going to be turning that into a covered call ETF? Or is he just going to be investing in companies that produce a dividend? The mid cap, what are the themes? Are we going to see our beloved SoFi in there? Who knows? That's going to be interesting. A little surprised about that. So nothing that I heard was surprising, and I think that we got to see what happens when it comes to the whole crypto market. I think that anybody who thinks that we're out of the woods, I don't think we are. Anybody who thinks we're going to have a quick reversal, I can't tell you that we are. I think we just got to wait it out, see what happens. Now, the Fed is going to be a big overhang, everyone. And I think everybody needs to gear up and get ready for a situation where even if NVIDIA has really good earnings and the markets are choppy because there's no clear indication that we're going to get a cut in December. Let's see where CME Group has the rating. So, oh my God. This is crazy. It's only a 42.9% chance that we're going to get a 25 bip cut. What the hell is wrong with these guys? All right, December 10th. It's going to be here before you know it. We got Thanksgiving next week, short week next week, and 2 weeks after that, you got the Fed meeting. So we know that it was a hawkish cut last month. We know that Powell's been overly hawkish. Some would disagree with that. That's just my opinion that he's been overly hawkish. We know that he has said that there may not be enough data. We know that they love their data. The fact that we did not get the unemployment report and that we have been relying on ADP for jobs reports, I got to tell you, there is a very good chance that we just get nothing in December, as the markets are showing us. I think this would be absolutely horrible for the economy, absolutely horrible for the American public, and difficult for the stock market. In an event where large companies are laying people off, we need the interest rates to be lower for several reasons. One, the people that get impacted the most by debt are people with high debt. It's pretty simple. Credit cards are predatory. There's a lot of credit card rates that are absolutely crazy. And when you have high interest rates, borrowing capital, whether you're putting it on a credit card or taking out a loan, is just more expensive. Cost of capital is just more expensive. I am truly in the camp that the Fed should leave rates at 2.5% and not tinker with them unless it is dire straits. The reason why I say that is because if there is a situation where there is too much demand for something, companies will come in and produce because it will create an opportunity for them to make money. If there's an opportunity to make money, the free market will figure out a way to fill that void and everything will right size. Now, when companies are borrowing at very low rates and then they have to roll the debt and refinance the debt, when interest rates coming out of the pandemic, when the Fed had rates at 1% or even less than that, and companies were borrowing, maybe they got a 3.5%, 4% loan. With rates where they are and them have to refi a business loan at 7, 8, 9%, what do you think is going to happen? That completely destroys their profit model. And one of the only ways that they can make up that margin is by conducting layoffs, which sucks. Input prices aren't going to change unless you're talking about oil, then that changed with the commodity market. But a lot of input prices to create the cost to create the goods, that's not really going to change that much. It's embedded in the business. Your operating costs are embedded. You have a 30-year lease on your space, your 15-year lease on your space. That's not changing. That's increasing every month with CPI. So you want rates at an incentivized level for companies to borrow, to be enticed to borrow, and to expand. You want people to believe that they can borrow and create a business for themselves, and you want to incentivize entrepreneurship, especially at a time when big business is laying people off. We need to have an economy where small and medium businesses can thrive, and you cannot have that in a high rate environment. And I really don't like the games that are being played with interest rates. I really don't. I'm sick of it. And people need to look back 5 and 10 years and look at these models. Look at the housing market. You had people taking out mortgages at 2.8 to 3.2%. Obviously, people were not getting out of those to go upsize or do anything, because why would you pay extra? The difference on a 500,000 or 600,000 or whatever you want to put down as your mortgage, the difference between a 3.2 and a 6.2% mortgage rate is huge. And we need to have an environment where that cost is lower. And it would be really great if we had an environment where that did not fluctuate. It would just make too much sense, because when you think about, after you pay taxes to the government, your biggest expenses after the mortgage, there's not much left for a lot of people. And we need to make it where we bring prices down. I got to tell you, I want rates lower, and I think that they should stay lower for a long time, and we should not influence them unless there's a catastrophic reason to. And we'll see what happens, but I'm not getting a good feeling out of the Fed. And if they don't cut rates, I do think that we could see the S&P at 6,200 by the end of the year, because I think it'll be a very bad signal. And while not cutting is not necessarily the sign of a recession, okay, I am worried that this time, if we don't cut, it will force more layoffs, and our unemployment rate will go up significantly, and we will find out that we are going to be currently in a recession in a couple of months from now. Now, we won't find that out until 2026. But if unemployment keeps going up, get ready, because 2026 may not be a good year, and we may see a recession, unfortunately. And at this point, with AI and with robotics, the only way that we can protect businesses and protect the job market is a lower rate environment. You can't have rates at 4 or 5% and then business loans at 9% in an age where you're getting productivity gains from technology. The model just doesn't work for jobs. It just doesn't, period, full stop. So that's the rant on that. So we'll see what happens. We need NVIDIA to do good. We need the Fed to do the right thing and cut. And then we'll see what happens. We know that the next Fed chair is going to be dovish. We know President Trump wants lower rates. In fact, we know a lot of people want lower rates on both sides of the aisle. And whoever is going to be the new Fed chair is going to be aligned with a lower rate environment. They're probably going to gain some influence on some votes. And let's see what the dot plot is. All right, I actually think the dot plot's going to change significantly. Here we go. So they're having it where we end this year at around 3.5%. I mean, they're really not even factoring anything for next year, which is crazy. And then 2027, they're at 3.25 roughly. Let's see if that's end of next year. Yeah, 3 to 3.25 is the most likely scenario for next year. That's crazy talk. So you're telling me that from now until the end of next year, they're going to only take 75 bips off as the most likely scenario, and a 50 bip off is 20%? Come on. That's crazy. This was much steeper to the downside several months ago. As it just doesn't make sense. I think this is going to change. We'll see what happens in May and June. Let's see who is actually selected. We'll go from there. Let's see. All right. Let's see. I am going to go through the chat and just start looking at things. I don't really want to go down the whole AI rant. Maybe I'll save that for tomorrow night. So yeah, I'm going to start reading the chat right now, and we'll go from there. Write a letter to Papa Powell, or I hope he's watching. I mean, you can send this to him. Maybe I think that I'm going to write it down. And we are on the light side tonight. I'm in a better mood than last night. When I write with this pen, it's the dark side. When I write with this pen, it's the light side. I'm in a better mood tonight. Write, post about rates. All right. I guess you guys are going to get a big, long post on X about rates from me. Making me do it. Making me do it. Oh, Maddie Money's still here. Maddie Money. Matt, if you would like to come on, come on. Check your X, Matt. I thought I sent you the link. I apologize. I think I did send you the link, actually. But if I didn't, here you go. Feel free to come on. Am I interested in adding to PayPal? Not really. Not really. If Alex Chris came out and did a really big dividend, I would have, but no. Oh, I'm so sorry. Matt's subs may go down if he hangs out with me. Matt, I'm so sorry. Everybody, please go follow Matt Money because he lost subs because of me. Truly. Oh, you guys want me to talk about Apple stock? I got one better for you. There's an article coming out on Seeking Alpha tomorrow morning at 8:45 in the morning about Apple. I did a 2,300-word rant on Apple. It'll be published tomorrow. We'll talk about Apple tomorrow night. I will say this. Their holder for the iPhone pissed me off that much that I went scorched earth on Apple. So we're not going to do it again tonight, but we'll do it tomorrow. We will do it tomorrow. Because my blood pressure is going to go up too much. Freaking Tim Cook. Freaking Tim Cook. He needs to be cooked right out of there. I like that. Future so bright, we gotta wear shades. I like that. I like that. Hey, don't freaking sleep on IBM. IBM's had a phenomenal year. Phenomenal year. Yeah, I'm very disappointed in Apple. Their cash from operations is not growing, everyone. I mean, I did the full analysis in my Seeking Alpha article. I really don't want to go through it tonight, but maybe I'll give you a little glimpse of what I put together. I need to start labeling this stuff better. Where the hell did I do it? It's got to be in this, doesn't it? It's not. Where the hell? Oh, no. It's probably my Apple spreadsheet. Why wouldn't it be my Apple spreadsheet, right? Hold on. It's not. I don't know where I put everything, everybody. I'm sorry. That's really interesting. Oh, no, I think I found it. Hold on. Did I find it? CapEx. No, I didn't find it. We'll do Apple tomorrow. I don't know where all my stuff is for it. I obviously didn't label it correctly, so we'll do it tomorrow. But yeah, they're not innovating. Their cash from operations is barely increasing, unlike their peers, and it really set me off. So I did an article about why I'm annoyed with them. It's actually really good. Let's see. Yeah, look, it's all about NVIDIA this week. I'm with you. Pint of ice cream never hurt anyone. I'm with you. Yeah, Meta's been holding 600. Look, to me, Meta's the most inexpensive Mag 7 stock there is right now. I think Meta is very undervalued. That's just my opinion. And I like Meta here. I think people are going to be thoroughly surprised about what happens with Meta in the future. Do I like dates? I like the dates with the coconut shavings on the outside. I think they're delicious. The fancy dates, as people would call them. Yeah, I think they're delicious. I don't know where the hell this is. This is actually really annoying me that I can't find my Apple stuff. I did it yesterday. It's unbelievable. But I did find one thing that I put in there. So hold on. Let me show you guys this because this is pretty freaking wild. Apple has spent or allocated next to no CapEx compared to their peers. $55 billion over the past 5 years in CapEx. Whereas Meta and Microsoft, 175 to 186 billion, Alphabet 218 billion, and then Amazon 381 billion, but they have a whole logistical network. I mean, this is exactly why their cash from operations is not growing, because they have not been investing in themselves. They've been buying back a ridiculous amount of stock, which I'm okay with the buybacks, but I am not okay with them putting themselves in a position where they're losing in AI. And guess what? I get it. that they're going to integrate either Gemini or ChatGPT, blah, blah, blah. But that goes against everything Jobs did. I mean, think about this. Apple used to win because they had everything on the same platform and they owned the ecosystem. They had the same ecosystem. They had the best ecosystem, some would say. Now they're subbing out part of it. They're subbing out the brain of it. They're going to be held hostage. What happens on the first renewal? What happens? They do a deal with one of these companies. They build everything on top of this brain, okay? 3 years from now, their cost goes up 50% because now they're locked in. They can't go back on this. I don't like this. This puts them in a position where they have no leverage. And it puts them in a position where they have no leverage on pricing. I hate it. I hate it. I hate it. And Tim Cook cannot be gone quick enough for me at this point. So that's where I am on Apple. I really hope everybody reads my article tomorrow, and I'll do a discussion about it tomorrow night. It's just, man, I'm very sad about Apple right now. I know that Coinbase allows people to stake. I cannot stake in my state, I don't believe. I guess I'll have to research that, but I'm pretty sure I can't stake. That's just me. I'm pretty sure that is true for me. I can now. All right, I will look at it. Thank you for letting me know. Appreciate it. Yeah, I will look into it. I do appreciate it. Thank you. Let's see. Not getting into politics, guys. Sorry. Apple reminds me of the modern day Sears. Well, Sears wasn't producing 100 billion in pure profits, so I don't know if it's the modern day Sears, but I get what you're saying. I do get what you're saying. I don't think it's the modern day Sears, though. I think it's far from that. And this is annoying me that I don't know where the hell I put all this information. God, I have too many freaking spreadsheets, everybody. Somebody should, I need to get somebody just to manage my spreadsheets for me. I do a horrible job of this. Horrible job. Bitcoin's dumping again. Oh, whatever. It's going to take a while, everyone. It's going to take a while. No, I mean, I'm not really hiring, but I can pay you in cookies. Somebody wants to help me out, I can pay you in cookies. I should start a cookie company. I think that'd be pretty fun. Will I be going to a MITS meetup? I am going to try my best to go to a MITS meetup. I'm going to try my very best to go. Most likely I will be there. And I may even get a Milkman shirt. We'll see. See if what I can do. Yeah, I know Apple confirmed Gemini. I don't like it. I mean, I can sell pizza and cookies. I could. What about the cannolis? Well, I mean, Matt's saying that if he goes, I'm not going. But, you know, I send Matt an invite to come on. He don't come on. I don't know. I don't know what's going on with Matty. Thoughts on Ackman's advice? I haven't seen Ackman's advice. Somebody send it to me on X. Ackman's been really vocal lately, hasn't he? Freaking Ackman. Ackman's giving advice on dating. Oh boy. That would be an interesting read. You guys are going to come to the meetup with cookies? That's hilarious. Wait, come on. It's Sir Joseph Carlson, not Joseph Carlson. It's Sir Joseph Carlson. Let's get it right, everyone. Sir Joseph Carlson. I don't think Chris is coming, everyone. Sorry about that. He did text me that he was coming, but I don't know, he probably got held up. When does the pain end? The pain, this isn't pain. This isn't 2022. This isn't pain. Guys and girls, come on. This is not pain. Like, we need to take a step back, and realize that this is just volatility. What's changed? Big tech has done pretty well. Whoa. The last cannoli you had was from Walmart. That's the problem. You can't get cannolis from Walmart. Walmart shouldn't even be allowed to sell cannolis. Stop it. Come on. Yeah, look, I'm a buyer. I'm a buyer right now. I'm not buying. There's things I'm interested in right now. So I'm a buyer, everyone. Okay, and maybe I do need to think about that there's a lot of new people in the market, but I mean, new people as in what, a month? Sure, if you've been in the market for a month, it's painful. But if you've been in the market for a long time, this is not painful. What was painful was living through 2020 and not knowing what the hell was going on and having cities shut down. That was painful. And that's another thing. I compare everything to that time in 2020. This is nothing like that. So if we got through that just fine, I mean, maybe not just fine, but if we got through that, certainly getting through this. I just don't think that we need to freak out. I really don't. I am about to freak out that I cannot find this freaking stuff that I built for Apple. I'm really getting annoyed. Where the hell is it? This is actually crazy. And maybe this is happening for a reason, so I take the labeling stuff more seriously. But this is nuts that I can't find what I'm trying to find. And I might have to spend time freaking rebuilding it. God, what is wrong with me? Listen, I'm not getting an ISOC. Nobody get me an ISOC. I don't want anybody to hand me an ISOC at the meetup. Do not spend your money on it as a joke. Your money is better off in your pocket than that. Please do not do it. I cannot be more clear. Do not spend any money on that for me. Please. And I know you guys are thinking about it as a joke. Your money is better off in your pocket. Please don't do that. It's the dumbest fucking thing they've done. The fact that they did that and put it on their damn website is fucking crazy. I like this. Out of any stocks what are your top 5 at these valuations? I mean, look, Meta's my number 1 right now. And look, I don't have a list of like 50, but right now, I got to tell you, Meta is very high on my list of things that are undervalued. And I can bring it up for you. So just give me a sec. Why is Google not working right now? Hold on, Google price is not working, which is not good for my tables. All right, here we go. So for big tech, got Meta at 17 times or 18 times forward earnings. It's the cheapest in the Mag 7. Meta's trading at a cheaper valuation than Coca-Cola. Full stop. I think it's the best value right now, in my opinion, out of big tech. That's just me. I actually really like Microsoft here, and I really like Amazon here. I mean, Alphabet's still really interesting here. And even though the valuation is really interesting, the run has got it. It's been on such a big run that I think it's going to lose a little bit of steam. But Microsoft and Amazon are very interesting. Look, he tried to call me. I told him live. He has the link. I mean, I see it. Oh, he texted me. He's joining now. Okay. So Chris overslept everyone. So he said he's joining now. But yeah, Meta's the one that I like a lot. Now, Amazon, I do think that Amazon is really interesting from the aspect of they are expected to be $1 trillion company. They are expected to do that in 2029. They have the ability to improve their margin with AI and robotics. If they can get their margin from 11.2% to 20%, that's $200 billion of operating income. That's more than double what NVIDIA does. That is maybe 80% more than what Microsoft's doing. So to me, Amazon's really, really interesting. I really like Amazon here. I really like Meta here. And I am planning on starting a position in Microsoft. I think Microsoft is very interesting here. So those would be the ones that are big tech that I like. So. Yeah, I get it. Amazon's margin, 11.2%, is not that interesting. But if you don't think that they can get to 20%, I mean, I don't know. I gotta think they can. We'll see. Not worried about Amazon's debt load by any means. Man, that makes me even more pissed. I can't find this damn cash from operations table that I built out. Where the hell is all this stuff? Like, this is actually crazy that I can't find any of this. And why would I not have put this in the freaking Apple spreadsheet? I got to do a better job of labeling everything. I apologize. It is inside the computer. It's in the cloud somewhere. I need to set up a lot of things in my Google Drive. It fucking sucks. You will work for milk. Listen, the milk I get from the farm is fucking delicious. At this point, I want Tim Cook to leave. If you saw my Google Drive doing a search, I mean, just putting Apple in brings up so many damn things. It's not good. Let's see. You guys may have figured it out. Hold on. Hold on. I found it. You guys are so damn smart. I had it on the tile view, and I switched it to the list view, and I filtered by date modified and saw a spreadsheet I did not click on. And thank you. So I now have that. Thank you very much. Appreciate it. What's going on, Chris?
Ugh, dude, my bad. I literally
All good.
hold on one second. I'm trying to just get myself put together. Stupid thing. And I'm getting hold on. There we go. That's done. That's done. That's good. Default. I have to connect my headphones. What's going on, Steve? How are you doing, man?
Doing good.
All right. First, let me apologize. I overslept.
Why?
I
I get it. That's why I didn't call you. I figured that you were sleeping or something came up.
yeah, I was wondering. I was like, I didn't get a call or anything. I was like, why didn't you just call me? But yeah.
No, as I figured, listen, if you're sleeping, I didn't want to call you and wake you up because you got work tonight. So
My wife woke me up. She's like, I think Steve just mentioned you, like, we're supposed to join today. I'm like, yeah. So I was like, ah, crap. Let me get up.
it's all good. It is all good. I went over
Okay.
NVIDIA, the Fed, BMNR, and my rant on Apple and how I want to disown Tim Cook.
Why? He's delivered shareholder value.
He delivered a sock.
A sock?
Have
On
you
what,
seen-
earnings?
No, have you seen this?
No. What
Oh,
happened?
dude. Oh, everybody, you're in for a surprise. Let's see what Chris Patel's reaction is going to be to the Apple fucking sock.
I just woke up, so please tell me it wasn't so bad that people dumped
Chris,
Apple like 50%.
I want to fucking disown them, and I'm going to go over why. I refrained from going over why. Now I'm going to.
iPhone Pocket? Ugh, oh my
Now,
God.
this is Apple's actual website. How much do you think this is? And before you tell me, look how beautiful this is. This 3D printed sock for your phone. How much would you pay for this?
I wouldn't. I wouldn't be caught dead with this thing.
Right, but how much would you pay for this?
I wouldn't pay anything. Well, maybe like $5. You could get this in Chinatown.
So I said $49.99 is probably what this retails at. right? It's
Okay.
Apple. $49.99 is like a decent guess, right?
Yeah.
Okay. And I'm sorry, everybody, if there's children watching. I'm going to tell you right now, I'm going to start cursing. Okay. Everybody, I'm going to start cursing. Chris,
Yeah.
if you would like a short strap, $149.95.
Maybe this is a joke, dude.
And
Maybe
if you
this
would
is
like a
actually-
long strap, $229.95.
maybe this is one of those things that, like, it's like a joke, just to see. I mean, it cost them nothing to do it. It's not like, yeah, it's probably nothing. This is like, like those people that buy, like, when you're in the city, you ever seen those Supreme stores where these
Yes.
idiots are standing in line and it's just a
Where-
regular, yeah, it's just a regular t-shirt with the stupid Supreme thing on it, right? And it's literally like, it's just a regular t-shirt with Supreme on it. It's like there's
Right.
nothing else special about it, but it's like this, I guess, the status symbol or whatever that make people go out there and buy it, and watch a whole bunch of idiots start. Like, all you need is like maybe 5 celebrities wearing this thing, and then everyone's like, oh my God, I need to go buy it because it makes me trendy or fashionable or whatever. So what does it cost these guys? Probably nothing.
Nothing.
So it's a
Now,
marketing gimmick.
here is why I'm so angry.
Mhm.
And the article is coming out tomorrow on Seeking Alpha. It's
Okay.
because over the past 5 years, okay, we'll do 4 years because there was a big jump in 2020, 2021.
Thank you, honey.
So let's put this here and let's do over the past 4 years. Apple's revenue has increased by 13.76%, and their cash from operations has increased by 7.16%.
Okay.
Every one of their competitors, Microsoft has increased their cash from operations by 65%.
Mhm.
Google, 65%. Meta, 86%. Amazon, 182%. And guess what? In 2021, Apple was the only one that broke 100 billion in cash from operations. Now,
Mhm.
Amazon, Google, and Microsoft all produce more and significantly more cash from ops than Apple. Because they have not spent on CapEx, because they missed the boat on AI, their cash from operations is not going up at the same rate. Their revenue is not going up at the same rate. And they have now hamstrung themselves where they're going to be relying on Gemini. They're going to get a teaser rate. They're going to build off of the Gemini brain. And this is where Apple thrived because they own the entire ecosystem and everybody loved the iOS. Now, Alphabet has them by the balls because guess what? They build off of Gemini, they embed that into iOS. 3 years from now, with the teaser rate, oh, no, Apple, 20 billion. No. 50 billion a year ago, fuck yourself. They have no leverage now.
No,
It's-
no, I disagree. I disagree, Steven. I disagree.
Ugh.
Because so the thing is, Tim Cook, for everything that he is a very, very shrewd operator. And if you think about how these guys are playing the current situation, they know that all of these guys have their own frontier models, right? So it's not like what Google is doing is unique, right? If anything, this is the same thing with the browser again, with the browser default. I mean, imagine the deal. Like, Google got to keep its search quote unquote monopoly by getting paying Apple like $20 billion a year. What is it?
Hopefully they're just going to swap and say, we'll give you Gemini if you put Chrome as the default or something. Hopefully
Yeah, I
we
mean,
are freaking swapping services.
the deal that's going to come around is going to see that, number one, Apple does not have to spend money on a crap ton of capex with zero ROI into the future. And I mean, if you look at the performance of each of these things, I mean, Apple's a steady Eddie right now. Like today, in today's market, what happened to Apple versus everyone else? A lot of these other guys, as this whole like AI trade unwinding like fear is coming around, these guys are getting smashed. Because why? Because so much of their cash flow is going to CapEx with no hope of return. Whereas Apple's like, I know where the return is going. It's right into my shareholders' pockets. Their EPS is growing. So while the other guys are taking risks on AI, these guys are like, look, we're Apple. We don't need to take the risk on AI. Like, we didn't miss the boat. Like, I mean, the other thing is, I think they have a very, very good understanding that they don't necessarily need to have all of these giant data centers and spend the capex and everything else, because their biggest data center is going to be their phone. I mean, I'm looking at a lot of these models. I told you the couple of things that I'm researching right now is one, there's a couple of models of China, and it's amazing how compact these models are starting to become, where you could actually run them off of a phone, right? But they have that huge parameter. So you don't need necessarily all that compute going to a data center and coming back. You can do it right on the phone. And I think eventually we're going to see something like that happen, where we're going to see the intelligence level on Apple actually get better, better, and better. Right. And so right now, I mean, you could see it. Look at the demand for Apple phones. I was before I fell asleep today, I was actually reading about how the amount of demand there's out there for Apple 17 is crazy. Like, it's one of their biggest upgrade cycles right now. My question is, what the hell? It's just an orange phone. Like, what's the big deal? But I guess people
Well,
are
I'll
like,
tell you
"Nah, I want
why.
a new one."
I still have a 14 Pro Max. I do
Mhm.
so many emails on my phone. I refuse to have a small screen because I use my phone a lot for work, and
Mhm.
my battery is for shit. And when I go in, it says that my battery health is at 85%, but it sure as hell doesn't feel like, because I have to charge it 2 times a day now.
Mhm. Do you know what this is?
Don't even tell me that's like a 12 or 13, I feel like. No, it's
X10XS.
not.
It is. It is.
Wow.
Yeah. I
How is
mean,
your
look,
battery not fried?
well, first of all, I work from home, right? And I've maintained it really well. There's no scratches, no nothing. I have a really good case on it. And I've gotten phones for everyone in my family, and I've upgraded them, but I don't know. I'm very loyal to my phone, so I've kept it. I know it's easy to transfer. I've helped other people transfer all their stuff to a new phone, and my wife, believe it or not, that like we were talking about like getting stuff for each other during Christmas, and I was just like, I think I'm just gonna get myself a new phone, you know. So yeah,
Do you use your phone a lot for work?
no, I have a work phone,
Okay.
so
I
yeah,
was
so I
gonna
don't.
say, I can't live without the big screen on the phone. It makes a world of difference.
No, I mean, this to me, this is like the perfect size. It fits. I don't like big phones. Like, I know some people, they like these giant screens. No, I like something that I could just hold in my hand, you know, and have. Yeah, it's a good phone. Yeah, but like I said, I do have to eventually get it upgraded, because I do notice that too. Like, the battery after this many years is starting to kind of. When did the XS come out?
Oh, the X
It's
came out, what, 2018, 2019, something like that?
okay. So yeah, it is, like, I would say 5 to 6 years is a good amount of time for a phone. You know, it's not a decade. Some people are like, it's a decade. It's
No,
not
it's
a
not a
decade.
decade, but it's getting close.
Yeah, it is getting pretty close. I mean, I've seen this phone through a lot, man. Eh, I'll get a new phone. You know, bad boy over here. It's been running good. I mean, this is the one thing you gotta admit, and I know some people are gonna hate
It's
hate it.
amazing. The
Like,
iPhone's amazing.
these things, if you treat them well, if you charge them, if you do all this stuff, you get a good case for it. These things last, you know, with the exception of the battery, which is normal. That's just normal battery degradation. But, you know, all the software and stuff, it's still supported pretty much. I mean, it serves the major functions that I need it to serve. So my thing was, why do I need to upgrade something where everything works fine? You know, not to but there is a couple of caveats. I do have an iPad, a newer iPad that I got because I do like using the new iPad. You know,
Which one did
it's
you
one of
get?
those. I have to see, but literally, like, we got it as a as like one of our friends who's a lawyer. he did a case for us a while ago, right? And so he basically gave it to us. I have to find it, but dude, iPads are awesome. I love the iPad.
Amazing. I just
Yeah,
got my
especially
dad the new 13-inch Air. It's
Yeah.
so nice.
Yeah, I have to get my niece an iPad for Christmas, so I gotta go shopping for that. I was actually thinking about getting a Mac Mini to replace my desktop because this thing is. I like my desktop. It's a gaming desktop, but it gets dusty. Like I have to. This weekend, my weekend project is going to be taking this thing out and just airing it out again.
Don't you have a gaming desktop that has a 3090 in it or 4090?
4090, yeah. Yeah, but it gets dusty. It sucks in all this air, and then it gets super dusty. Like I can see the dust building up on the front screen.
The fact that you're running a 4090 is insane. Because you got that when that video card alone was like $1,600.
Yeah. But the reason why I got it, because I have these moments in life where I'm like, man, you know what? I need to get back into gaming, and I'll start. And then somewhere along the lines, I just run out of time. And it's like, damn it. Like this, everyone's been asking in the chat. I'll finally tell people, yes, this is a Switch 2. Me and the wife, we actually.
There's nothing wrong with that.
Yeah, I know, but I haven't played it for a while. I got it for Mario Kart.
I have been watching PC building videos lately.
So you're thinking about building another computer?
Dude, I go down the freaking rabbit hole and I'm like, I really want to build a freaking computer, and I just disassembled one because I wanted to destroy the hard drive and all the parts. And as I'm taking it apart, I'm like, I don't want to put one back together, man. I don't want to have to be careful where I'm pushing things in. So I may just go to Micro Center and just go buy another MSI.
If someone needs some RAM, let me know. I ordered some Kingston RAM, and it's actually good RAM. I was supposed to send it back to Amazon, but I literally forgot to. I did not know this about RAM. If you buy RAM, you have to buy it in sets.
Yeah, you can't just do, you have to do opposites on the motherboard.
No, I did the opposites. Fine, I have them, but I have like 4 slots,
4 DIMMs,
right, on my AMD, right? So I'm thinking, okay, if I just order 4 of this, so I already have two RAM modules. If I just order the same modules, I'll put them in the other 3 and double my RAM. You can't do that. I don't know why. It's weird. I was like, so why the hell do I have 4 slots then? Like, it makes no sense. Like, I have the B560 motherboard for AMD, right? And I'm like, so then I'm reading about it. I was like, wait a second, I can't expand this thing? Why? I mean, and it's really good. So if someone in the chat, y'all want some RAM, let me know. I'll send it to you. It's a Kingston Fury KF556C 5600 megahertz DDR5 with XMP. Like I said, they work. It's just now I can't use them. It's the stupidest thing, man. It's like, oh, it's an AMD motherboard. Yeah, man.
Listen, AMD's chips are freaking no joke. They're absolutely no joke. Yeah, I was looking at new computers. I'm like,
you know what? If you want us, don't buy RAM. Don't buy RAM. I'll send you these.
I'm not going to build one. I'm just going to buy a pre-built.
Yeah. Yeah, I'm done building my own computers, man. I'm fucking just buying a pre-built. This is like sometimes like there's so many like little nuances that you need to know with these new pre-builds with compatibility stuff. And I know there are websites out there that have like compatibility lists and everything else, but the problem is if you try to upgrade something, all the vendors they throw in little things that make like compatibility sometimes don't work. It's the dumbest thing. So now I'm more like I'll just buy the computer.
I freaking put Star Wars The Old Republic on my computer the other day, and I started playing the Star Wars MMO, and I'm like, maybe I should get another computer. Get ready for GTA 6.
I'm good with GTA 6.
I can't wait for it. I'm gonna take a week off from work and just crackhead it with Matt.
I need to stop alerts on Robinhood. This thing keeps alert. Bitcoin is now $91,000.
I don't have alerts on anything.
Yeah, let's see what the price of Bitcoin is now. It's 91.60. Okay, so
Before we get into that, let me just show you
Yeah.
this. I bought this for my nephew. Look how good of a computer this is. Like, people are gonna laugh. My nephew's 9. Keep that in mind, okay? My nephew's 9. All he plays is Roblox and Minecraft. But for $750, look at how solid of a computer this is.
Yeah, it's pretty good. 550. It's got a 550, 16 gig DDR5. By the way, anyone who's saying you need more than 16 gigs of RAM, you don't. I thought I'd
not unless you're doing freaking real big CAD work or playing like crazy games, you don't need more than 16. But for a starter computer for a 9-year-old, this is legit.
Yeah, it is. It is.
The fact that you're able to get a 550 video card with the Intel chip, the motherboard all built up, I mean, and the big air cooler inside,
Yeah.
is a solid computer. I've never had an issue with MSIs, ever.
Yeah. 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 The few games that I did play when I got this was Red Dead Redemption. Love that game. Red Dead Redemption 2.
2, it's so good.
Then I had Space Marine 2.
Never
Loved it.
played it.
Oh, dude. Space, like I am. You want to know, that's been one of those stocks that I wish I had bought a long time ago, because I have been a
Why?
big,
Who built it?
Who built what?
Space Marine 2. What game? What company built the game?
Well, the thing is, the IP is owned by Gamers Workshop. Look at the stock. It's a British company.
What's the ticker?
It's, hold on one second. It's on my Robinhood. Gamers Workshop. It's GMWKF. It's on. That's our OTC symbol.
Gotcha. Oh,
Look at that. It used to be $7 in 2016, and now it's almost like 220. Yeah.
Talk about a crazy freaking run.
Just show everyone. Show everyone. Do the.
Yep.
What's it called? That thing.
That's wild.
Yeah, it's just I never thought to look for this, because I was like, oh, it's like it's like a hobby thing. But right now it's almost a $7 billion company. So I don't know if anyone here is in the chat a big Warhammer fan, but dude, I love Warhammer. And if anyone grew up playing any of the games and everything else, like just how big the Warhammer lore is. And so there's a lot of IP that this company has that's coming out that's very, very successful for these guys. So they've got like 3 or 4 arms of business that are really good, but it's basically that IP that's super, super valuable. So I'll give you a couple of things. Warhammer 40K is there, and there's like other things, but so Space Marine 2 is a game that first came out, I think, in 2010, and the latest one came out in like 23 or 24, I want to say. I think it was 24. Yeah, 24. And it was just rock solid, dude. One of the best games of that year. Sold so many copies. So there's like an entire modding community. I love the lore behind it. So yeah.
Yeah, I need to find something to take my mind off of shit. So I may start playing games again. Dougie introduced me to the Xbox Game Pass. They now have a subscription model where you can get 200 games for like $15 a month.
Nintendo has the same thing too.
No, they don't.
I joined it.
No, but you can do it on your computer with Xbox.
Oh no, you can't do it on the computer. It's like through the Switch too.
Like you don't even need the hardware. Mm-hmm. So I was like, oh my God, I can freaking go get MLB The Show and just play it. Like, jeez.
Yeah. Yeah, man. So no, I mean, like I said, there's opportunities out there that I wish sometimes I was a little bit more cognizant of. and got in early because like I knew these things were going to be big because I just, you can kind of tell like how certain things are just what is it called? Certain things are just really good franchises, but you just never think to like, oh yeah, let me go see if they have a stock. And then if it's not on the US, you're kind of like, oh, well, I don't see it actively on my Robinhood. And that's like the one thing about Robinhood that you don't really get a lot of what is it called? Things on here. Like the one thing I think Webull has that Robinhood doesn't, and this is something I was going to talk about, is Robinhood is really, Webull is really leaning into corporate bonds. Like that corporate bond thing is actually really good. I like it. I haven't bought anything on there. But I like that you can just go to the company, find, like I was talking to you that day when we were looking at it together, right?
I think
Their
it makes
CEO.
incredible.
Yeah, I think the CEO actually did an interview recently and actually mentioned that as well, about how like they're trying to make the experience for retail investors in the bond side much easier. I think it's possible. I mean, here's the thing for anyone here in the chat. I know it's like bonds, like, what do you want to do? But let me kind of show you guys and explain to you how a bond differentiates from a stock and how sometimes the bonds can actually be very attractive, not just from, hey, a return standpoint of yield, but also from the standpoint of capital return, right? So let me just bring up the screen and I'll show you. So you're looking at these are all the stocks that are, these are the ones that I'm tracking right now, but you have two parts of a bond. You've got this part right here, which is the face value of the bond. Not the face value, sorry, the current trading price of that bond. And then you've got the face value of the bond. So most bonds, their face value is $100, right? But then what happens is, depending on how the company performs and also at the the yield that you basically have, the coupon rate, people will pay different prices for that underlying bond. So we'll take two examples. So here we have Google's bonds, which mature all the way in 2027. Okay, and if you see here, this move down, Google, that bond went from $102 per bond to 101. So there's not like a lot of juice here. But on the other hand, you're getting a 5.7% coupon, which is great. So you're like, oh, well, every year I'm getting 5.16% yield on a company like Google, which is a free cash flow machine. So in this environment, everyone is looking at this and saying, well, I can put my money in the money markets and get like, what is it right now? 4.5 or 4.25%. Well, if you bought this with Google, you could actually get this for, you could get like 5.7% yield. Now, the thing is with bonds, they can actually go over par. And the way that it can go over par is that, let's say the Fed drops interest rates to 2% and money market now becomes zero again. This wasn't a very long time ago, a couple of years back, where money market was what? It's like nothing, right? At the time, people were dying for yield like this. 5.6% on a AAA company like Google, bro, that would be amazing. So the value that people would be willing to pay is like, let's say 3, maybe 4% if interest rates go low enough. So if you do a 4% rate, that would be 100 times 0.04. So that would be like, I have to look at like what the yield would end up being, but this would go way above par. Now, on the other hand, you've got another bond. This one is an Amazon bond. So you can see this, and let me see when the issue was. Must have been a while ago. Okay. So this bond, when it was issued in September of 2022, was trading above par. And at the time, the yield on it was about 3.2% because, interest rates were basically at ZERP. So what ended up happening was it was worth 109. Now all of a sudden it's worth 65. Why? Because interest rates went up. So that 3.25% yield is not necessarily attractive to income investors. Now, what if the Fed lowers interest rates? If the Fed lowers interest rates, this thing will climb all the way back up to, well, close to par again if the Fed lowers them enough. So this way you can actually get a nice capital return as well. And the entire time that you have this, you're basically getting paid. And the thing is, your yield to maturity right now is about 5.5. So not only are you getting every year 5.5% to wait, but then you also get a nice $40 run on top of it, right? So you can see, this is what we were talking about last time, Stephen, which is sometimes if you look into the system and you find the right bonds, you can actually do really well on it. So, and what I like about this is
the Oracle bonds that they issue trading right now at a good price.
Say that again.
The Oracle bonds, are any of them trading at a good price?
Depends on which one you're looking at. Like, do you want more capital appreciation, or do you want, see, the one thing I'll caution everyone here in the chat when it comes to bonds is that there are a lot more complicated things about bonds. So learn all you can before you even try to attempt to buy corporate bonds. There's things like covenants, there's things like priority, whether they're secured, unsecured. Most retail, they probably shouldn't buy bonds, to be honest with you. But in terms of attractiveness, it kind of depends on what you think the rate environment is going to be going forward. I personally think rates are going to be coming down. So from a duration standpoint, I think we should probably find something with a very low ask with a good amount of duration still left. So like this 3.85 is trading at 63 cents on the dollar, which is a 6.5% yield. I think this one would be okay, because I'm more concerned with the capital appreciation portion of things, because I think interest rates are coming down. Now, if you think interest rates are going to stay where they are for a prolonged period of time, then maybe this is not the best thing, and not to mention you won't be able to sell it without, sell it at par. You'll have to wait all the way until like 2060. This one is 2040. This is 2046, 2041, 2040. I don't know. I'll wait until I'm more of a wait until there's some market distress and these things get oversold, and so this way you get a nice yield off of it. But nothing that seems like super attractive at the moment, to be honest with you. Energy is where I where the money sometimes is, because what happens with energy is you get these moments where oil prices come down, and all of a sudden a company goes from positive ops cash to negative ops cash, and basically you can buy bonds sometimes at 10 cents on the dollar, and all the company has to do is survive. And the thing is, if it's 10 cents or 20 cents on the dollar for a particular bond, the yield is absolutely insane, right? So let's say you have an 8% coupon, right? And the face value of that bond is $100, and now it's trading at, let's say, 10 cents on the dollar. You can buy it for 10 cents on the dollar, and basically now you get this massive yield, because the yield on an 8% bond trading at 10% at 10 par, it's like 60-70%. So within 1 year, you're already recouping most of the money in interest. And then let's say oil prices, they go back up again, or or natural gas goes back up again. All of a sudden now those bonds go to par. And so now you went from 10 cents to 100 cents. You made a 10x return, plus you got this thing that on your cost basis is yielding like 60-70%. So it's pretty lucrative. But that's where you have to like invest through the cycle. Let me see if I can find an example for you guys. Give me a good oil major, because oil majors are
Chevron
usually,
or Exxon, one of the two.
I want to Exxon only because Exxon might be a little bit too powerful. I don't know if their bonds ever really go at a discount because they're
About
just
like
so diversified.
Conoco.
Let's see. So this is Chevron. Look at this. Chevron. Can you believe this shit? Chevron has better. It has a AA credit rating. It's got better yields. No, I'm saying worse yields than freaking Amazon and Google and Oracle. And these things are cyclical. Okay, so let me show you guys. So this is Chevron. This is I need another issue. I need like something that's a little bit older. CVX. Give me another oil major that's a little less known.
I mean, ConocoPhillips is a big major. You got Occidental.
Okay, Oxy is good because Oxy took on a lot of debt, right? So Oxy would actually be a perfect one. So look at the yields on all of these things. They have a 100-year bond that literally is maturing in 2096, and it's non-callable, and the yield on it is 7%, which is pretty insane. They probably got this because they bought someone who already had this debt. Okay, so let's do a 5-year chart. Okay, here we go. Okay, so if you see this in 2020, around COVID, this bond was trading at $64 $64 per bond. Okay, so not only is the yield on this thing like 7.7%, if you were able to buy this at this price right here, you would have got every year just for holding this around 12% in just interest payments based on your cost basis, right? So if you put $100 in this, then let's just do a calculator real quick. So if let's say you bought this, so you would take you take $100, divide this by 63.42, you get 1.5 times 7.73%. You would have got a 12% yield every year for the next 100 years. Okay. Now imagine right now you had a mortgage that you were able to refinance for 3%. You took that same money and you put it with, Oxy. You would have got a 12% fixed return every year that would have helped you pay your bills. And by the way, this pays twice a year, semi-annually. And this is the best part. When things recovered, it went back up to par again. And so now it's back to $100. It's 106. So you took that same $100 now, and it actually has almost doubled. So look at the total return on something like that. Pretty crazy, right? And there were multiple times where these things were selling in the 70s too. So what happens is when oil prices, they go down, a lot of these super majors, their bonds start to go a little bit in the toilet. And you can actually pick them up relatively cheap. The only problem with something like this is that the bond market is very, very illiquid, which means that the bid and ask price between two different things can be pretty significant. So sometimes you have to act. I mean, to be a bond guy, you got to have some money. Like, look at the order minimum that you need just to get in.
I can't see it. What is it?
It's like 50,000. You need to have like an order quantity. So this is the bid and ask for bonds because it's very illiquid. So if you want to buy this, right, you need to basically, this is what's out there. So if I wanted to buy this right now, amount in face value, I'd have to like, each bond is like $1,000. So let's say you want to buy right here. If you want to buy this, it would cost you, let's see how much it would cost actually. Face value, amount in face value. I have to look it up. I haven't used this yet, but this is why I have a guy at Fidelity who basically, like, I just call and just say, hey, listen, I see there's a new issuance. Can you get me in? Or, hey, I'm looking for this. Because Bond Desk, it's not as simple as this. You actually have to put an order in, and it doesn't get like filled. Like, there's no like instant fills. And yeah, I think this is what Webull is eventually trying to do, which is trying to make things a little bit more instant and more friendly towards shareholders. I'm not shareholders, to like a new group of investors. But yeah, yes, but liquidity in companies like this is really good. I mean, not like liquidity in the super majors is good enough to the point where you could theoretically have like decent fills. If you look at like really, really small companies, those are horrible when it comes to filling. So the bid and ask can vary significantly sometimes. So
Yeah, I need to start adding some bonds to the portfolio.
yeah, basically, to anyone here who's a retail person, don't do bonds. Don't do bonds. It's that there's such a big learning curve that I don't even know why. This is more like an exercise in understanding what a market is rather than trying to get people to buy and sell bonds. I don't think most people have the especially on the retail side, don't necessarily have the time to commit to understanding how big of not how big, but basically what they're buying. You know, it's not like stocks where if you buy it, it goes up and down left and right. But if you look at like Oxy's stock price, Oxy has not gone anywhere in the last 5 years. So stockholders, look at this. In the last, let me do 5 years. 5 years. Oxy stockholders, you could have bought for like $15, and now it's at 41. Around that same time. It got all the way to 70 and it's back down to 41. So it's a lot more complicated, basically. Bonds versus covered calls. Covered calls have timing issues where things can go way past your strikes, and that could kill you. Imperius Maximus says you have Boeing bonds. Okay, let's see. Boeing. Let's see, Max. So Boeing is a triple B issuer, so they have a decent amount of bonds that are outstanding. They've got some 2063s, 7%. It's not bad. What's trading above par? Whenever there's like bad news, is typically a good time to buy a company like Boeing's bonds, because I don't know if Boeing's going anywhere for a long time. So let's see the last 5 years max. No. Let's do a nice 5%. They probably didn't they probably issued this a while ago. Okay. So you can see here, this Boeing bond, when it was issued, it was yielding 5.8%, and interest rates had gone down. So it was trading way above par. It was trading at 136. Since then, it's gone down, and it went all the way down to 85, and now it's trading at 98. I mean, this is not a bad one, to be honest. I don't know if Boeing's going anywhere. So, sorry, bonds are boring. Yeah, unless it's a convertible. By the way, I don't know if you know this, but Trump has been buying bonds. He bought a bunch of Intel bonds. Wait, Trump bought a bunch of UNH bonds too? That's good. UNH is another A+ issuer. So they've got a bunch of bonds right here. By the way, this thing has probably come down. This is 2064. These things were trading. Yeah, look at this. This was a 24 issue, so this was 107. But let me look at UNH. Let's do something that was issued or something that's trading way below par. for. Okay, we've got this one. This was trading at in 2022. This was trading at 106. Is up 86. The thing is, like, there's not going to be a lot of opportunities for capital appreciation on some of these bond products when it comes to businesses like UNH. And the reason why is because UNH is not cyclical, right? UNH, if you look at it, it's like nice, steady eddy growth. Whereas the oil industry, it has these moments where it goes like this and like that, right? So oil prices drop, cash flows drop. So people are like, oh my God, this company's going out of business. So you'll see like the bond price get cut in half and then oil prices go up. And now all of a sudden they're cash flowing again and they just go up in value. So, yeah. Chris deflecting bonds on Webull. I don't know what that means.
I have to think that Webull product's pretty damn good for bonds. After really looking at it, I really like it.
Yeah. With bonds, the other thing is you guys, so let's say a company has, I don't know, let's say 5 billion in debt outstanding. Without going into too much into the weeds of it, let's say the stock goes bankrupt. Like, let's say a company goes bankrupt. The first people who have dibs on assets in bankruptcy are people who are bondholders. So let's say the assets that the company has, whether that be interest in other companies, property, and all this other stuff, the bondholders get the first crack at the return on that. So they're the first ones to get paid out. So unlike stockholders get wiped out. So they're in bankruptcy, stockholders pretty much take the brunt of it. And then preferred shareholders take the brunt of it. Then you have the unsecured bondholders that get hit. And then last but not least, it's the secured bondholders who are like at the top of the security. So it's almost like this waterfall that happens with buckets, right? Where the top gets filled first in terms of total recovery, and then it gets the second, and then third, and then fourth, and that's how it works. So a lot of times what happens is, like, you look at Oxy right now. Let's say Oxy went bankrupt during COVID. The first people that get paid out would be secured bondholders, who have first lien priority. And then who gets paid out is like the second lien people. They get paid out, and then unsecured shareholders, and then after unsecured, it's like preferred equity holders, and then after preferred, whatever is left goes to common. But to be honest with you, most of the time, common gets 0, preferred gets maybe like a 5% recovery, unsecured gets 50. Second lien typically gets made whole, and secured bondholders get everything back. So
that's why BDCs love senior secured debt. First in line.
It says not true. Banks get paid first before secured bondholders. It depends on if the way that the deal has been structured by the bank. All right. There's a lot of banks right now that, like, if they really want to make a deal, if they don't have anything in the paperwork that's securing those assets, then the banks don't get shit. Okay. Like, here, like, I'll give you an example. You have to look, this is where you have to understand a company's capital structure to understand who gets what. So give me a company with, actually, I got an idea. Hold on. So this is Venture Global's. So Venture Global right now has 30 billion in bonds, and I think this is a good segue to understand how it works. It's usually there's one thing in every chart. Okay. So right here, this is the corporate structure of Venture Global. So a lot of people think Venture Global, one company, bonds, everything, stock. You're getting stock in the company Venture Global, which is at the top. But then what happens is each one of these things are different subsidiaries. Okay, and depending on where these subsidiaries are, is where sometimes the payout can come from. So what a lot of companies do, and if you're not in business, you may not understand this, but do you know why Trump has been able to declare bankruptcy so many times and is still a billionaire? Does anyone here in the chat, they know? Do you know, Stephen, why Trump has been able to declare bankruptcy and is still a billionaire?
No, because when you have different corporations and you declare bankruptcy, you're only defaulting on what's part of that corporation. You're not
Exactly.
defaulting on any other assets. That's why people
Exactly.
have 10 different companies.
Exactly. So what tends to happen is everyone thinks like, oh, Donald Trump. So imagine Trump was all the way here at the top. Rich people, they don't just put all of their assets under one name, under one liability. Why? Because let's say one business goes out of business, it doesn't do well. What happens is that can carry over into the other parts of the business that are healthy. So what happens is you as a corporate entity can own multiple things. So you can see here, Venture Global has three different, well, not three, it has a bunch of other subsidiaries. So you've got Shoe Pass, you've got Venture Global Commodities Trading LLC, which is their trading arm. Then you've got their midstream holdings, which is their pipelines, right? So they own joint venture. So 50% of their pipeline holdings is owned by a different company. This is the company that's underlying them. And these are the bonds that are, or the debt that's secured from here. Okay, so you can see here 1.4 and plus 75 million. All of these things are secured by here. The reason why I say that is because if, let's say, Venture Global goes bankrupt, right? These things can't say, you know what, you owe me money for this project over here. All they can do is target this right here. Okay. Then you've got Venture Global CP2. This is like bridge financing. So this is connected with this project. This is connected through this. So when it comes to subsidiaries, you can put a subsidiary in bankruptcy if it's not doing well. So imagine right now you own 5 properties and 4 of them are cash flowing and the 5th one has it's not cash flowing. What can you do? Well, you could strategically default on the 5th one and say, you know what? I don't see a future in this one. Let me just basically give the keys back to the bank and say, here you go. Take your keys back, fool. I don't need this building anymore. And the bank can't say, let me get interest in the other 4 properties that you have, because they're not secured by that. It's only secured by that one building that's not making money. So businesses, they have a corporate structure that's set up in a very similar way. That's basically protects against one asset destroying the entire company, basically. So yeah, you have to really understand like capital structures too when it comes to investing in bonds and whatnot. Like I said, most people, most retail, they don't necessarily do the homework required to be in it. So I'd say probably just avoid them, but at least get a foundational understanding of how the bonds actually impact a company, because if you understand how they impact a company, you can sort of get an idea of where their earnings should be. I had this discussion on Patreon a while ago when it came to like Carnival cruise lines. So a lot of people were like, oh, why would you buy Carnival at the time? And I was like, if you look at their debt, which I happen to do, you can see that sorry, where did it go? Presentations. I want that supplemental. And what's funny is this is all out there. It's transparent. Like there's no like secret things that are out there. It just takes a lot of really good work. So if we look here, this is their debt in 2024, right? So you see this right here, this 10.5% fixed. During COVID, when they were struggling, they had to issue a lot of debt. So they were right here. Like this $1 billion was trading at like $10 and not $10, $10.50, which is 10.5%. And then over here, you can see this other one is like 7. So if you did a debt analysis on this properly, you found out that these guys actually had a bifurcated debt schedule where they have a whole bunch of debt that's literally like fixed 1%, 2%. But then you had this other debt that was trading at double digits. So for them, the best course of action from the CFO standpoint is just pay down your high debt, keep all your low debt. And now that all of those interest savings go right back to shareholders where you can actually pay down more debt. So this was a very cool thing that I was able to do. And basically because of that, their EPS just shot up. And now if you look at the same company's debt schedule, they no longer have that ships in our fleet right here. They no longer have that 10% bond anymore that they have to pay on. See? Because they paid it off. And so if you look at it from a cash flow perspective, if you have $1 billion in debt that's yielding 10.5% and you pay that off, right? You basically just saved $100 million for taking out that one bond. $100 million of savings that goes directly to the bottom line. So a lot of times, if you have a good CFO's job is basically making sure that the debt is well accounted for. It's very similar to how, like if you have credit card debt and you have a mortgage, what are you going to do? You're going to pay off your mortgage or the credit card debt. Like which one would make more sense to pay off? Obviously it would be the credit card, right? The credit card has a higher yield than the mortgage does. So you want to pay off the credit card debt. But sometimes it can be advantageous to actually not pay your credit card and just tell the credit cards, because you got so much, go kick rocks. I don't want to pay you. I'll keep paying my mortgage because mortgage is somewhere I need to live. Right? So what ends up happening is the credit cards come after you, they'll ruin your credit. But at the same time, eventually they'll put you in collections and all this other nonsense. But, but the house is yours. You get to stay in your house. So, and the other thing is the credit cards can't say, I want your house now. Do you know why they can't say, I want your house? Because the house, the primary lien holder on the house is the bank. So then you got creditors kind of like beefing with each other. So, you have to know these things. Mortgage and utilities over everything else. Yes, that's correct. Yeah. So understanding how things work in your personal life is a good idea too. So like credit cards, that's unsecured debt. That's not secured by anything. That's basically a credit card is just lending you this money because they think you're going to pay it back. Versus the bank, when it comes to a mortgage, the bank owns your house. The bank owns your car if you have a car note. The bank is can go after your assets. With a credit card, they can't really go after your assets because it's literally all they could really do is ruin your credit. Student loans, on the other hand, are different, where you can't discharge them in bankruptcy. And student loans, because they're backed by the government, they can garnish wages. So make sure you pay your student loans.
It's crazy that student loans are not disposable in bankruptcy court. It is so predatory. No. It's disgusting.
Well, it's predatory, but they have to do that. The reason why is because once you go to school and you get, let's say, $150,000 education, what is the bank going to do at that point? What recourse do they have to get any of their money back from you if you were able to discharge in bankruptcy? Everyone would just go ahead and discharge, like literally they would graduate, declare bankruptcy, the entire debt gets discharged, right? Everything goes away. So the banks now, instead of lending you money at 5, right now at 4, 5, 6%, they're going to ask for 10% interest. And they're not going to guarantee everyone. So that's why the federal government kind of steps in there and says, hey, listen, we'll guarantee this debt. And the minute that the federal government guarantees the debt, the banks are like, we don't give a crap who you lend this money to. You can lend it to an art major with a 2.6% GPA. And the banks will say, fine, here you go. It's all going to the government anyway. The government's going to pay it off. And this is like the perverse incentive. So the government comes in saying, I want to help people, able to get loans, but then you've created a situation where you're sort of like putting the tax holders on the hook for someone's bad life choices. And then the colleges, they go completely out of proportion when it comes to raising tuition. Why? Because the government's backing all the loans. So the day that the government got involved with student loans is the day that you best believe student loans, I mean, the cost of tuition was just going to keep rising. And that's always the case for any any business, where once the government comes in and starts subsidizing risk, you're going to see the cost of everything go up. Like health insurance. When Obamacare came in and guaranteed all these people health insurance companies are like, okay, fuck it. Government's going to give us this money. Let's go. Let's make this money. They started raising prices, and here we are. So, like, you have to let the free markets do its thing, but sometimes the free market can get also a little bit too much as well. So, as an example, should a 25-year-old that weighs 400 pounds have the same insurance payment as someone who's 25, doesn't smoke, doesn't do drugs, has a good BMI? Should they have the same interest? I mean, should they have the same insurance payment? What do you think, Steve?
No comment.
Yeah, I mean, of course you're going to say no comment because you're not political. But the thing is, that's a real question. Now, Obamacare, you can't do that. You can't, like, if you are this, if you're within the same age range and in the same location as this other person, you guys both have the same insurance coverage. Even though the person who's 400, 500 pounds, guess what? They're probably going to need way more in terms of medical cost, right? So the insurance companies, they can't exactly price things based on that. I could understand like prior existing conditions and all this other stuff, but you're basically creating a situation where the incentive structure is to not have the most efficient use of resources. So what ends up happening? The person who's like 400, 500 pounds, they need way more medical care. The person that doesn't need it doesn't get any care. Well, doesn't actually utilize any care. And now it's basically subsidizing the other person. So you're making one group of people subsidize the life choices of another group of people. So yeah, BMI is nonsense. It doesn't factor into bone muscle. Maybe to some degree, but if you're talking about someone with like 40 BMI versus someone who's got 25 BMI, there's a big difference. Like I could understand maybe a few points here and there to account for muscle mass versus anything else. But bro, you're talking some people, they're looking like they have their own centers of gravity. Those people are gonna need a lot more care in the future. That's not to say like, oh my God, like, I'm fat phobic or anything, but bigger people tend to get worse health worse health care outcomes. Now, one of the things I think that's a really big move for the government is that they're finally going to allow these GLP-1s to become more mass market. I think that's going to have a dramatic impact on overall health care for people. Have you seen like Amy Schumer, how much weight she lost? And like Lizzo?
Real.
Huh? Say that again?
GLP-1s are real.
Yo, GLP-1s are a game changer when it comes to the fight against obesity. It's crazy, dude. Crazy. Lizzo. I can't even make fun of Lizzo anymore. Have you seen Lizzo? Lizzo, how much weight she's lost? Megan the Trainer. Do you guys know in the chat who Megan the Trainer is? Or not Megan the Trainer, but Megan Trainer. So this was Megan Trainer before, okay? Like, and now Megan Trainer after the weight loss is this. So she went from this to this. Can you share the screen real quick?
Yep.
Yeah, look at that. She went from that to this, from here to here. Telling you, Ozempic, man. Let's see another one. Lizzo. Before, after. I mean, Lizzo was big. So you said this was Lizzo before and this is Lizzo now. Crazy, man. Crazy. So I think and this is because of GLP-1s. No one is gonna tell me that she's like working out and that's why she lost all the weight. She did that. Oprah was the same thing, I think. Oprah actually admits that she was taking it before. And yeah, see, here to here. See? So right now, obesity care is going to be a really big thing. And I think the Trump RX, like Ozempic, which is a Novo Nordisk product, they're losing market share right now. But I think the amount of people that are going to be on GLP-1s in the near future, because of just how prevalent it's going to be, is going to be pretty insane. So the total volume is going to be up there. So yeah, we missed the move on LLY on Eli Lilly. Yeah, Eli Lilly has a very Steve, you got to do a better job of controlling me, man. I'm going into like 80 different tangents.
I'm letting you cook, man.
There's no cooking. Chris is just going on to so many tangents, man. You gotta. I was waiting for you to say something, so I'm just like acting like I'm filling in space right now.
No, I mean, listen, there's a big opportunity in GLP-1s. There's a big opportunity in a lot of healthcare stuff. I don't know what is the area to be in.
What do you mean? Like, so there's 3 ways you can play GLP-1s. You can play the incumbent, you can play the disruptor, or you can play the possible future disruptor. So you've got Novo Nordisk, who was the first one out of the gates with Ozempic. Then you've got Eli Lilly that came up with a better product called Mounjaro, right? Or Wegovy, whichever one you want to call it. No, not Wegovy. Sorry, Zepbound. And those have been really effective, and they've actually gained market share while Novo Nordisk is losing market share. And then you've got newer players like Viking and some of the other ones that their drug hasn't been approved yet. So their full potential is not basically been realized, but from the results, they look promising, right? So each one has kind of got a different audience. Novo Nordisk, I think, could do really well in the future if they're able to successfully launch their oral tablets, not the older one with this, which is called Riblet something sauce, but this newer one that they have coming out in the next few and like probably the next like few months. But oral GLP-1s are going to be coming out soon, and they're going to be priced supposedly by Trump RX at like $150 a month. So I would assume that there's going to be a lot of insurance companies that end up carrying this. And so if you think about risk pools, if let's say you have the patient population who's got a lot of huge BMIs, if all of these people have access to GLP-1s, they all start losing weight. I think the healthcare outcomes are going to actually diminish. I mean, the healthcare outcomes are going to get better and the cost of care is going to go down, which means that the insurance companies are actually going to be able to make a better margin. So long term, if you're looking 5 years, 6 years out, this could be very big for companies like United Health and Centene and Molina and all of these guys. If the healthcare outcomes of people start getting better, while at the same time the cost of care moderates. Is there a side effect to the obesity drugs? Yes, there are side effects. Every drug has a side effect. The side effect for GLP-1s is you have to look it up. I'm not going to lecture people.
Yeah, let's not go into that. There are side effects. Do research.
Yeah, do your own research. Someone said once daily tablets Ribelsis. That's right. They have a new drug that's coming, a newer version that's coming out. That's going to be technically more impactful. Yeah.
So Chris, where do you think NVIDIA does on Wednesday. That's the Super Bowl right now.
I don't know, man. Too many people are laying all of their hopes on NVIDIA saving us from this market downturn.
No, it's the only big thing we got until the Fed. So,
Jeez. Bitcoin just went below 90,000.
did it?
Yeah. For a brief moment, it's back up to like, I mean, it'll probably get down to
Where's
80s
Ethereum?
now.
2,800?
ETH. Let's see. Ethereum is ETH. Damn it. How come I can't just see Ethereum? Oh, here it is. 29.77. It was below 3,000.
I hope it goes to 25.
Why?
So I can buy a lot more.
Okay. This is where I got caught a little bit flat-footed. I had no idea how big of a liquidation event October was. Did you?
I didn't realize how many people were on margin.
Yeah.
Is what I didn't realize, because a lot of people got caught having to sell into weakness, and I just didn't realize it, nor do I care, because I can't call tops and bottoms. I am long on Ethereum, I am down on Ethereum, and I am buying more Ethereum for that exact reason. I never go all in off the bat, because I know that I can't read a chart perfectly, and I know that I can't control the market. And Ethereum's 5-year chart has several downturns that look exactly like this. So it's one of those things. My long-term investment case has not changed. So if I liked it at 4,000 and 3,500, I should like it at 2,800.
So I guess this might be a good idea for a lot of people to understand what exactly happened. Let me just basically show people. And I had, like I said, I had no idea how big this liquidation event was. And because of it, confidence has been shaken in the crypto markets. But a lot of people who were max leveraged Ethereum and who's max leveraged a lot of cryptos, they got absolutely decimated. 1 second, let me just do October. Like, you're talking about, some people lost millions of dollars. Like, they lost their entire portfolios. That's how bad it was. Crypto.
Yeah, and you know what? Don't go on leverage unless you have cash to back it up, because you may have to sell into weakness at that point. Like, it's just, I don't understand why people put themselves in that type of position. I'll never understand it.
It happens. People get greedy, man. So right here, the crypto industry recently had one of its worst days, while Bitcoin and Ether holders seem to have put some carnage behind them. Yeah, okay. Basically, if you guys remember, with Bitcoin and Ethereum earlier this year, October 10th, everything was at all-time highs, right? So Bitcoin was at, I think, like 122, 126 at the time. Trump came out and basically said, we're putting 100% tariffs on China. Right here. So the crypto wipeout came as Donald Trump vowed on October 10th to impose massive tariffs. So what happened, honey? You're going to sleep? Okay. Thank you. Just leave it out for me. Appreciate it. Love you. So when Trump came out with this tweet, everyone, it basically scared the shit out of markets. Like, this was like Liberation Day Part 2, if you guys remember. Like, people, that's what people thought. So what happened? All these people who had all this leverage, they were max leverage on crypto because everyone got super bullish. Tom Lee was saying, Ethereum's going to go to like 12,000 or whatever. So all these people, they loaded the boat. And not only did they load the boat, but they borrowed a whole bunch of money to buy more Ethereum, buy more Bitcoin, buy more blah, blah, blah. All of a sudden now the position drops. And what ends up happening is now the market makers, they're looking at it and saying, they have automatic triggers. So they don't lose money. What they had to do was they had to liquidate. So the selling pressure from all these liquidations really, really pushed the market down, right? So all these people that were sitting on margin Essentially, that's what it is. They had bought a lot of crypto on margin. They got liquidated, and as they get liquidated, they don't have money now. So there's no money to buy the dip. So now that entire event comes, everything cascades down. And what happens is some of these people are probably like the most confident in the crypto markets. So they're not like, hey, I'm going to go out there and buy more, right? They just got liquidated. Like a giant position just got liquidated. So because of that, the amount of people now that are no longer on leverage is up there. So as Ethereum and Bitcoin is dropping, people are kind of like scared, and there's a lot of fear in the market. So no one's willing to buy Ethereum and no one's willing to buy Bitcoin right now because they think, I lost so much money during this period of volatility. I'm not going to go buy it. And if I buy it, I'm not going to buy it on leverage, which is smart. You don't want people to buy it on leverage, but essentially, because people are not buying it on leverage, the value that's supporting it is not necessarily, or the demand picture that's supporting those buys is not very high. So fundamentals of Ethereum and Bitcoin, as Tom Lee said, have not changed since October 10th. What has changed is the risk appetite people are willing to put into this market. Now, at some point, enough dip buyers will come in to support the underlying price, right? Because they're like, wow, this is just too valuable to be in, to not be in it. So the market has not found that floor yet. That's why we're seeing this constant move down. Now, this is where you have to think like an investor saying, hey, I loved Google at 200. I don't like it as much at 150. I hate it at 100. Like, that's not how you invest. You're supposed to invest in the opposite direction. You're supposed to say, I don't like Google at 200. I kind of like it at 150. I love it at 100. Because there's underlying value there, right? That's the way you're supposed to kind of like structure your investing philosophy. So has the stablecoin picture changed at all since October 10th? No. Has adoption for stablecoins changed? Did Larry Fink all of a sudden say, sorry, crypto is a scam again? No. Did JP Morgan not issue their own stablecoins? No. So the underlying fundamentals of Ethereum have not changed, but the risk appetite for Ethereum has changed. And that's usually a good sign of when you typically want to be in something where the risk appetite, it's really low. And that's why you get this fear and greed sentiment. And, and like I said, you have to be able to write out that fear. That's why today I was just like, cool. Let me look at some underlying fundamentals on Ethereum. They're going to have this massive upgrade on December 3rd. They tested everything. The network is going to become more valuable over time, but a lot of the speculators have been washed out of this market. So,
which makes a healthy market at the end of the day.
Yeah.
Look, I'm a buyer. I don't care where it goes from here because the long-term thesis is still intact. You said JP Morgan, for them to start getting bullish on stablecoins, you have MasterCard, you have PayPal, you got Shopify on Ethereum layer 2. So I'm not worried. I can endure the pain. It does not matter one bit to me. And I'll just buy more. Yeah,
me too, man. Like the way that I look at it is like, just look at on-chain volume. That's what you really need to focus on. Because if you just look at the volume of stablecoin issuances and all this other stuff, you'll understand what the value of this thing is long term, right? So, yeah, man, it sucks right now to be in this position where things are down, but it happens. This is one of the
people look at their portfolios too much.
Yeah. So this is the one thing I want to see hopefully in the next few months after the changes that are going to come around for this Fusaka upgrade. So let me see if I can show you guys one of the things that's actually going to improve Ethereum itself. Does anyone here in the chat, do y'all know about Fusaka? Do you know what I'm talking about? If you do in the chat, just mention it. By the way, You know, all these people now are actually they're using. Let me share my screen real quick. Can you share this? They're actually people are using Notebook LM to create video content now.
They're all copying you.
They're not copying me. Google created it. I was the one that used it, but some people like this is from November.
Listen,
16th.
you've been talking about Notebook LM for God knows how long.
Yeah, but this is a video thing now. So check this out. So this person posted this. So 1 second. Let's see.
And why is it such a big deal for the Ethereum network? Welcome to The Explainer. Today we're breaking down Ethereum's next major upgrade, Fusaka. So what is Fusaka, and why is it such a big deal for the Ethereum network?
It's a massive update for the whole network, set to boost pretty much everything.
Okay, here's the plan. We're going to cover the big changes and what they mean for you. The main event here, making Layer 2s way cheaper and a whole lot more powerful.
And it all kicks off with blobs, basically special temporary data packets just for Layer 2s.
But here's the magic. Instead of every node grabbing all the data, a new system splits the work. And the result? A massive, theoretical 8x boost in data capacity for Layer 2s. That's huge.
And get this, the zebra mascot, its stripes are a cool nod to how this data sampling works. And to safely add more capacity over time, they'll use these new, smaller, more frequent forks. So that's Layer 2s, but Fusaka also beefs up the main Ethereum network, Layer 1. First, a new gas cap per transaction.
Okay, I think this right here, Steven, is going to be a really big game changer for Ethereum Layer 1. So all of these other things, they're built on Layer 2. And so what happens is, in order to basically put everything on the main chain, they have to pay a certain amount of money, right? Now, the way that certain amount of money is priced is that if there's a lot of demand, they have to pay a higher price. If there's low demand, they get to pay a lower price, right? To Ethereum level 1. So what a lot of these guys do is they have sequencers that they wait for the transaction volume to die down, and then they put stuff in the then they utilize it. So now they're paying very little in gas in order to put things on Layer 1. So by changing this, where you're basically like standardizing the gas like limit, like that makes it more steady. You're actually going to have more transaction volumes. As more transactions come from level 2s, it's going to actually come on, and there's going to be like a minimum set, like a floor price set for Ethereum level 1s to get paid. So
this stops one huge transaction from jamming a whole block. They're also capping the physical block size. This makes the network way more stable and secure.
And the total block gas limit is going up, meaning more room for everyone's transactions. Okay, enough tech talk. What does this actually mean for you when you use Ethereum?
This next part? Well, it fixes one of the biggest headaches in all of crypto. Get ready for this. Passkeys are coming natively to Ethereum, a total game changer for wallets. This means using your phone's built-in security. No more seed phrases, so much easier. All right, let's wrap this up with the most important stuff you absolutely need to know.
Man, this guy really, I thought it was going to be a better video. Yeah, but these are all the different things that are going to be coming on the Fusaka upgrade in December 3rd.
That's the beginning of December. Okay.
Yeah.
2 weeks.
For me, I'm most interested about blob fees, like base blob fees. So let me see.
So the real question is, when do we get mass stablecoin adoption?
I mean, it's already happening, right?
Oh, it's starting, but getting mass adoption. I mean, SoFi starts Q1. And I think this is a first half 2026 thing.
Probably. I mean, you could talk to what's his name, Tom Lee, and he'll tell you it's next week. But I don't know.
Tom Lee ain't taking my phone calls. I'm not admit.
Oh man, I feel bad for Tom Lee because I don't think he's fundamentally wrong. I just think like sometimes the market has a way of basically throwing curveballs at you. And this is one of the reasons why I know people are like, oh, let's not talk about politics. Let's not talk about politics. But dude, if you have one man that has the ability to send out a tweet and crash an entire market and cause $1 trillion in losses, how can you not talk about politics? You know,
Pretty easy. You just don't talk about it.
yeah, but here's the Steve. My question to you is this: would you rather listen to someone who doesn't want to have those hard conversations, or do you want to listen to someone who has an all-encompassing conversation and tries to maximize understanding on something? Just because it's uncomfortable to talk about politics, does that mean you shouldn't talk about it?
No, it's not that it's uncomfortable. I just don't need to talk about it. I understand exactly what's going on, and I can profit off of it.
Yeah, but don't you think that other people in this community should be able to profit off of your understanding of politics?
It's not, honestly, it's not even worth getting into because it's the most dividing thing, and it's just not worth getting into.
And this is one of the things that this is one of the reasons why I'm not the biggest fan of social media when it comes to, like, and some people ask me, Chris, why don't you do your own channel and blah, blah, blah. And some of the reasons why is because I don't feel like people have it in them to have a nuanced conversation at times, you know, where you can be politically neutral and craft a thesis. And, you know, there's going to be anything you say, 50% of the population is going to hate you. And the thing is, if you can't be honest and just say what the honest truth is, and the environment that you create is so toxic, is it really worth talking about? And so sometimes I'm just like, do I really want to, you know, express my frustrations? And then some people hate
No,
it.
you don't.
You know, and that's the thing. Unlike Amit, you guys have this this ability not to talk about things. And you think that it's more valuable for people to not hear it, where I'm more like, if it's valuable, I'm going to talk about it. I don't give a shit. You know, but at the same time, I hate talking about it. So it's such a weird dynamic that you have to kind of play into this whole thing. But I get it. You guys are the Michael Jordans. You know, Republicans buy shoes too.
Dude, I watched a Jordan and Kobe video the other day. Man, unbelievable. I love basketball. Love basketball. Yeah. So where do we think? I have an early morning tomorrow. So
sorry, man. I'm sorry about being late, by the way.
No,
yeah, I know that. That's my
let's end it out with, do you think the Fed is going to play a game of not enough data and they're going to hold rates where they are at the December meeting?
So this is where, once again, it goes back into politics again. And like I said, people don't necessarily want to have that conversation, but I'll have it anyway. There are people within the Fed who are looking at the reacceleration in inflation, and they want to take a more cautious approach where they want to say, you know what, let's kind of hold off on the December rate hike. But if they just literally, and I'm almost 100% sure they're not dumb people, you can already see that the labor market is weakening. It's not hard to see. You type in Google, you know, layoffs, you can see all these major corporations are laying people off, and you could already see a downward move in employment. Yet a lot of people, they don't want to acknowledge it. And some of it, I feel like, is politicized, where they're like, look, we don't want to lean into one of our mandates, which is if the economy is deteriorating, the labor market is deteriorating, we should make sure that we're cutting. They don't want to do that. Now, how much of it is politicized, I can't really, I'm not in these people's brains, so I can't tell you. But then there are other people who are more biased towards supporting the administration goals, right, economically. So they're saying, like Waller is absolutely gunning for a position as chair of the Federal Reserve. So he wants to be nice. So what is he doing? He's going on the other side of it and saying, we need to cut. Stephen Moran, who's a creature of the current administration, is saying we should be cutting even harder. And he's giving the rationale for it. So I don't know exactly where they're going to end up lining up. And so right now, that's why the prediction markets are 50-50. You know?
Do you think it's going to be Waller or Bowman? Or do you think it's going to be someone else?
So I think it could be Waller. I think Waller has one of the best shots at it. Bowman might be a little bit too too green. So my thinking is maybe Waller. And I think, I mean, anyone that Trump picks is pretty much dovish. So in the short term, we can all speculate, oh, is there going to be a December cut? Is there not? If you don't get a December cut and the economic picture weakens, then you'll get a cut in January. Just chill. If you don't get it in January, you'll get it in February. Eventually, the cutting mechanism is there. So if you're thinking 2 months out, yeah, you're going to live in uncertainty. But if you're thinking a year out, the rates are going to be lower than they are today. Because the Trump administration is going to be putting in someone who's a lot more dovish. I personally think that regardless of the pace of whether we get one cut or two cuts, it's not going to make that big of a difference. I'm looking at the shelter portion of inflation rolling over, and it is rolling over hard. Okay. There are parts of this country right now that are in housing deflation. So when you aggregate all of them and you put them into the pot, and then you consider the amount of deportations and aggregate demand destruction that you've had, I can see next year a handle on inflation. Yeah, I can see a 2 handle probably, but I think we end 2026 at, and I'm going to go out on a limb and just say this, CPI being close to 2.1, 2.2%.
Interesting.
Where I think the market has got it completely wrong. I mean, not the market, sorry, the Federal Reserve in their projections, they've got it absolutely wrong. I think with the amount of people that are getting laid off, so the aggregate demand destruction that's there, then you've got all these deportations, that's going to hit aggregate demand, right? You've got resumption of student loans, so that's going to hit aggregate demand again. Then you've got mortgage moratoriums, all of those things are gone. That's going to hit aggregate demand again. You're going to have work requirements implemented for Medicaid. That's going to hit aggregate demand. You're going to have work requirements for SNAP hitting. That's going to create aggregate demand destruction, right? Everything is setting up for a much, much lower inflationary environment in 2026. Like, to me, it's fairly obvious. Why these guys can't see it, I don't know. And at the same time, if you don't cut rates and you keep the neutral rate higher, you're basically creating a system where businesses are not going to reinvest in the market, and you're going to get, you're going to get a deeper move down. And if we do get hit by a recession, well, it's just going to suck. Not to mention next year, we might have an increase in CapEx from AI spend, but I think in 2027, you could see the growth in AI CapEx could be well below what we had in recent years. What I mean by that is you just won't see a lot of growth in AI CapEx. You'll still see a lot of AI CapEx. You just won't see a lot of growth in it. So, and I think that's pretty much normal, because there's a lot of companies right now that are having to issue debt just to make their share buyback programs and CapEx goals work. Eventually, people are not going to lend money to Oracle. They're going to say, whoa, I'll lend you money, Oracle, but it's going to be at like 10%. And at that point, Oracle is going to have to say, wait a second, man, I might be too levered. So each one of these guys is going to get hit eventually. So I don't know. And the calculation that I think a lot of these hyperscalers are making is a very, very interesting one. And I think that their data is showing that inflation is coming down significantly. And the reason why they're issuing a crap ton of debt right now is because they know they'll be able to refinance it lower in the future. Steven, if you were a CFO, let's just play this exercise.
Yep.
If you're a CFO, you want to build this AI data center, right? A lot of your CapEx right now has to get funded. If you thought interest rates were going to go much higher, would you go ahead and say, you know what, let me go out there and build a crap ton of data centers right now? Or would you wait until your cash flow caught up to the point where you could actually build them out?
Well, it depends what I'm going to use the cash flow for. If we're just talking about you're going to borrow regardless, you spend the money now and you take out the debt now at lower rates. But if you believe rates are going down, you then have to play the game of, if I wait 6 months and it goes down 50 bips, how much am I saving versus how much am I falling behind? There's a fair line you got to walk along and you got to figure it out. But
For,
if they were talking about 150 bips over 6 months, you may end up saving enough on the debt, but also with the way the competitors are spending, it really depends on what the use case is. But in the event that rates were going to go up, you borrow as much as you can now because your cost of capital is less.
for me, I would say they are issuing all of this debt because they know that in the future they're going to be able to refinance that debt at a cheaper price. That it's fine to do right now. Because if they thought interest rates were going to be higher in the next couple of years, why would they issue the debt and then cause themselves a giant liability where now they have maturity walls coming? Right? Because eventually what's going to happen is the interest on your debt is going to eat away into your cash flows if the interest rates stay high enough for long enough. So their expectation is, hey, AI is massively disinflationary and deflationary, to be honest. They're like, fuck it, let's put the money towards this project now, and when the time comes to pay these, to pay this debt back, we'll refinance it at super low rates. So I think we are eventually headed into maybe even ZERP again. Who knows?
Wow.
What?
No, that's interesting.
I mean, it's
Maybe
possible.
Yeah, I guess.
It's possible. So, yeah, they don't care. A bunch of billionaires wanting to be first. Yeah, you could chalk it up to that. They're going to build AI gods regardless of 50 bips. Yeah. Like I said, I'm just thinking from a CFO standpoint where I would push back on the CEO a lot more if I knew interest rates were going to be higher in the future, because then I set my company up for tragedy. Because then what happens is the interest costs are going to, as things mature, the interest costs, if you have to refinance at higher rates, is going to kill you, right? It's going to cause all sorts of issues for your business. So right now, Oracle, they could 2 years ago, 3 years ago, they could issue debt at 2, 3, 4%. Now they have to issue at 5, 6%. And if they thought that they had to issue debt in the future at 7, 8, maybe 9%, that means that all that debt that they're rolling over, that's 2, 3, 4%, now they're going to have to pay 7, 8% on it. Look at what happens to your interest expenses if you have to go from 2%, 3% to 7, 8%. That's a 500 basis points increase in your interest charges per year. That means that your earnings are going to be impacted significantly. On the other hand, if you think that interest rates are going back to 2 and 3 again, whatever, pay the 5, 6, 7% right now, and in the future when it comes to time to refinance down at 2%, 3%, probably 4, but yeah. If all economists in the world hate tariffs, but Trump likes tariffs, who is more likely to be correct? So unfortunately, I think both of them are correct. I know that sounds weird, but Trump is according to the study that everyone keeps citing from the San Francisco Fed about tariffs are not inflationary. I think they missed the whole argument completely. Did you see the study?
I did not.
Okay, so according to the San Francisco Fed, they did 150 timelines. The tariffs are not inflationary. They're deflationary or disinflationary. And the reason why is because there's less economic growth. There's less output. So people lose jobs. And yes, if people lose jobs, that's less aggregate demand. If there's less aggregate demand, that's deflationary. Which is exactly what I've been saying for the last year now. So, yes.
Yeah, we're gonna see what happens when the Fed gets here. I'm just worried Powell's gonna make the wrong freaking decision.
I mean, I don't really care about Powell. I care about jobs.
The same here, but you need lower rates to support the economy because companies are not going to borrow at higher rates. You got to get rates down.
I mean, look, over the last 50 years, when have interest rates been lower than they are today? I mean, there's very brief periods over the last decade and a half where things were this cheap. All right. Everything else, like 7, 8%, 9% borrowing costs were the norm prior to 2008. You know, so if you're telling me businesses can't survive with paying 5, 6, 7, 8% interest rates, I
That's not
don't
what I'm
think so.
saying.
So what are you saying then?
That is absolutely not what I'm saying. What I'm saying is that you have businesses that took out loans at much cheaper rates 5 years ago. It's the same thing you
Right.
and I talked about with rates. You have
Yeah.
debt turning over. The Fed has not acted quick enough in lowering rates. And if companies have to refi here, their profit margins will compress. And the only way they make up the margin at this point is with layoffs. You need a interest rate market that will support small businesses and entrepreneurship, because as we see productivity gains from AI and robotics, which we will at some point, and we are now, you need an environment that can support jobs. The last thing we need is unemployment continuing to go up. So you have to have low rates to incentivize that.
I agree with you to some degree, where this refinancing headache is definitely one that a lot of businesses are going to have to adjust. But I think if you give it enough time, the capital structures adjust by themselves. I mean, here's a good question that Samuel Taylor said: what company borrows to hire more people? It's not like a 25 basis point cut will make businesses go out and hire all of a sudden. These job losses are current bloat being cut and AI taking jobs. That's a good question. But here's the thing. It depends on what the company's debt structure looks like right now. So here's an example. If you're, let's say, SL Green, you own a bunch of buildings, right? And you borrowed money at, let's say, very favorable rates at the time, like 4 or 5%, to buy a bunch of these commercial properties. And you have all these people that you've hired to manage these buildings and everything else. Let's say now all of a sudden a building, the mortgage comes due and now you have to refinance. And with commercial real estate, it's a 5-year term, right? So if you borrowed in 2021, 2026 is when that refinances. Now, all of a sudden, people are, the bond market is saying you got to pay 8%, which means your interest cost just doubled. Okay. The challenge that you run into is the lease that you've signed, you can't raise prices on the leaseholders by that much. Right? So you've got a fixed amount of rent coming in. So your cash flows are going to be impacted significantly. So one of the only ways that you can afford that giant upward move in interest is by cutting where you can, which is something like people, right? So on the other hand, if the Fed, let's say, cuts, and not only cuts 25 basis points, but cuts about 100 basis points, that means that when these businesses refinance, they're not going to have to refinance at crazy onerous terms that they would have had to if this whole thing hasn't happened. Do I think SL Green eventually gets to a point where they're cash flowing even with a 7% interest rate on their property? Yeah, absolutely. You know why? Because rents are going to keep going up slowly, unless of course Mamdani destroys New York, then it's a whole different story. But basically, as SL Green, every year the rent goes up, the ability for that business to pay that interest and still retain cash flow is going to get better, and better. So the challenge that you ran into here is you had interest rates that were like this for almost 10, 15 years. They went even lower during COVID. People took out these loans, and now a lot of the loans are coming due, but the interest rates are like that. So you typically want to have policy that goes like this when it comes to interest rates, not because business decisions can't be made in this anymore.
So let's answer this. I don't like sharing this, but somebody did want to ask you something.
Sure.
And I don't believe that you're bearish NVIDIA, but real quick, because I have been sitting here for 3 hours, I need to do a few things before I go to bed. I don't think you're bearish NVIDIA, but let's say, are you bearish NVIDIA? And do you think Google's positioned the best out of the Mag 7?
Google is best positioned out of the Mag 7. NVIDIA, I think, needs Okay, this is not necessarily being bearish about a company. It's just about realizing that the risk potential for the upside and downside weighs against the total return potential for NVIDIA. The reason why I say that is because NVIDIA, no matter what anyone tells me, is still a cyclical business. Okay, it's not a secular growth story. It can't grow 50% year over year for the next 2 decades, right? Which business would you rather have? You have the business that goes 50% up and then slows down to 30, 20, 10, -10, -20, right? Or do you want a business that grows 15% year over year compounded for the next 10, 15 years? Google, its entire business model is geared towards that 15% compounded growth all the way through. NVIDIA's got this giant wave of AI CapEx that currently everyone is under. But look, all the underlying businesses that buy a whole bunch of NVIDIA chips, they're all taking on debt. At some point, the debt is going to become a major problem for these guys because they're going to have to service that debt with existing cash flows. If the cash flows don't catch up in time, all of these companies, their first priority is going to be, let's decrease the amount of capex that we're doing, right? And if they're decreasing the amount of capex, it's not that they're not spending money on it with NVIDIA for their GPUs. It's just that NVIDIA's total growth is going to be like 10%. So question is to you, do you want to pay $5 trillion for a company that grows at 10% per year on their top line? And look, they have strong cash flows because they are an IP business. They're not actually making chips. They design the chips and TSMC makes them. So the margins that these guys have are insane. They're going to be buying back a whole bunch of shares for the foreseeable future, which means that'll support the stock price and support EPS. So it's a question like, hey, do you want to buy Apple or do you want to buy Google? Because that's basically what you're getting, right? Apple's been doing what? Taking its high margin product, right, that it manufactures in China, utilizing it to buy back shares, and eventually its revenue growth has come down to single digits now. Google's been able to maintain a 15% growth rate over a longer period of time, but Google's taking more risk. So this is a question of, hey, are you bearish on NVIDIA? No, I'm not bearish on NVIDIA. I'm neutral on NVIDIA. I don't see a lot of upside potential on NVIDIA. I don't see a lot of downside potential on NVIDIA.
Yeah, I mean,
right?
Here's where I'm in the camp. I think they hit 50% plus this quarter, but next year they're not hitting 50% plus revenue growth year over year.
It's a law of big numbers. It's a law of big numbers.
It's a law of big numbers. Now, I do think it's between Alphabet or Amazon that has the best setup for the next 5 to 10 years.
Don't forget Meta. Don't discount Meta.
The reason, look, Meta is the best value today. It makes me think Amazon, and I've said this before, I think Amazon's margin is the biggest area that can expand. It's 11.2%. I think they can get to a 20% margin. And if they get to 20% margin on $1 trillion revenue in 2029, $200 billion operating income. So Amazon's got a great setup. I love all three. I'm a shareholder in all three. Amazon's still my horse right now for the one that can do the most. But that's me on a pure margin game.
Here's a question that I have for everyone. How come Jensen hasn't just said, you know what? Screw it. We're not selling any chips to anyone. We're going to build all these data centers ourselves and basically conquer AI.
I never thought of that. That's actually not a bad question.
I mean, what? They got like 96% market share in AI GPU accelerated compute. He says that, hey, we don't ever have to worry because there's no competition. Well, why not just not sell to anyone? Just build all this, like just sell TSMC. Listen, TSMC, for the next 5 years, every chip that you make is going to an NVIDIA data center.
Chris, that's a good fucking question. I've never thought of that.
Because at that point, you're fucking monopoly.
Right. Well, maybe that's what they're worried about. Who knows?
No, the problem is I think that would incentivize these hyperscalers to do their own AI chip research, and eventually they would catch up. In which case now you would lose market share because now you're competing against everyone. So right now NVIDIA is playing this game of let these other guys, they fight each other for my chips, and I can charge them a huge margin for it. The problem is, I think, and this is something that I think even Jensen knows, is that eventually these guys are gonna switch away, because the amount of margin erosion that, like, Google is not in the business of giving away 50% margin on anything.
No.
Amazon is the same thing, and Microsoft is not in the same thing. Like, you tell Microsoft, hey, listen, you gotta pay the NVIDIA tax. No, they're all working on their own shit. Do I think that NVIDIA is gonna lose market share today? No. Tomorrow? No. 5 years from now? Maybe. 10 years from now? Hell yeah. I think all the hyperscalers are trying to figure out how not to pay the NVIDIA tax. But if NVIDIA were to not make them pay that NVIDIA tax and just say, you know what, you can't get access to Blackwell and Hopper and all these other things, I think all of them would, instead of spending money on CapEx to build out these data centers, they'll all spend CapEx on researching how to make their own chips. In which case the rate at which NVIDIA will get disrupted ends up going from like 5, 6, maybe 7 years to maybe 2 years. And I can already see Google's TPUs starting to impact that. Amazon's Infernia side doing the same thing, and then Microsoft with their whole thing. Meta's doing their own thing. So, I think over time they're gonna eat away at not necessarily NVIDIA's like product, but basically they're gonna decrease their demand for NVIDIA GPUs over time. I can't give you a timeline of when that's going to happen, but to say that these hyperscalers will forever be under the thumb of NVIDIA, when have they ever been like, yeah, let's tie our entire future success to this one company?
They haven't.
They would never do it. So
no, we'll see. We're going to see what happens, and the world is waiting for Wednesday. So I'm excited for Wednesday. We'll see what happens.
Yeah. Do you see any risk to NVIDIA's growth story?
Right now, no. But I said in the beginning to you 2 years ago at this point that I thought the CapEx build out would be 18 to 24 months, and then I obviously retracted that and increased it. I think we have I'm not in the same camp that we have another 10 years of this. I'm not in that camp. I do think we have at least another 24 to 36 months of expansion, but I don't think we have 5 to 10. I think we go in maintenance mode after 3. But just because I think we have a lot of expansion left over the next 2 to 3 years, that does not mean 50% growth year over year. I think the growth rates for NVIDIA are going to significantly scale down. And eventually they're going to be your normal 10 or 15%. It's not going to be this crazy number. So
let's just take a look at their growth rate really, really quickly.
I got it.
No, I already loaded it up, but okay. I want to see it. So where they were growing in April at about 200% LTM, last 12 months trailing, they've gone from 200 to like 71. And so last quarter, it was 55%, right? So like I said, the law of big numbers eventually does come. And because of the nature of how NVIDIA is, it's a cyclical business, right? Right now, you can see that during the early, in the 2010s, they were growing at 50%, and then it kind of came all the way down to like negative 19%. And then they had all the, what is that thing called? The Ethereum mining and everything else. So they went back up to 63. Then it came down to negative 12%, and then it shoots up to 206. Eventually, I think this goes in this direction, and I think eventually it goes into the negative territory again. And once it hits the negative territory, that's when people are going to get freaked out, and you'll see this thing go from a crazy high PE to a lower PE like multiple, because people are always going to question like, oh, when is it going to reaccelerate? So if you look at the stock price, it follows a similar pattern. Say that again?
The growth is not going to reaccelerate. I can tell everybody that. I mean, I'm looking at where the analysts have it.
Hold on one second. Yeah. So you see this cyclicality right here where things kind of shot up all the way. I mean, it's hard to see in this chart. So let me just simplify it. So you can see here in 2017, they were growing at 50%. So the stock price at the time went up. And then what happened? Their growth started to decelerate. Stock price went down, right? And then they started to reaccelerate and things went back up again. So, you know, and then you could see this time frame around here, 23, right? So you can see the stock price accelerate as the growth went up again. And then eventually the stock price starts to go down as your growth rate comes down. And eventually it bottoms out like a year ahead of time. So it went from, you know, $33 split adjusted to $11, $12. That's a 60% decline in share price, right? So then what happens? Then comes AI 22 with ChatGPT around here. NVIDIA goes in the other direction again. And so now you're back to this huge move up in growth since then. And now this is starting to slow down. So what do you think happens to the share price? It's not rocket science for people to figure this out. If the growth rate slows down to even 20%, do you think people are going to say, yeah, let me buy a $5 trillion company? Nah, bro, it'll dip down to maybe like 2-3 trillion, which is not unheard of, right? You don't think that a company like this can come down to like, because the growth rate is slowed down significantly? The question is now, would you short this company? And I'd say, hell no. Hell no, because you don't know what kind of verticals it has. Yeah.
Here's why you don't fucking short NVIDIA. You don't short NVIDIA because, and keep in mind, their fiscal year ends in January. So this, when it says January 26th, everybody, it's really the 2025 fiscal year. It's 11 months out of 2025. So they're going to finish this year, according to 56 analysts, 60% growth year over year, which is crazy. But
yeah, but I think we need to stop giving these analysts so much goddamn credit, man. These same analysts were
Chris. It was 5 analysts. That's one thing, but 56. Now we got 59 analysts. They're saying 40% next year. If that's true, they're going to add 85 billion in revenue at a 50% plus margin on profit. So you don't fucking short this. Now,
do you know how many analysts were saying Fiserv should be worth Fiserv should be worth $400? Out of 36, 35. 35 said that.
What's this ticker on Fiserv?
FISV.
Yeah, a bunch of analysts do cover this company.
Every analyst was saying this thing was going to be $11, $12. And then what happens? Company comes out and says, no, we don't have it. And then it comes down. We need to stop with these goddamn analysts who think that they know everything. Dude, most of these analysts, all they do is in the short term, they just use the company's guidance in the short term and just go based on that. They have no real understanding. And here's the other thing. They can't even go against their bosses because the bosses dictate to them where their numbers should fall to. Every analyst you speak to them, they're like, listen, I want to keep my job. So what do? They give price targets based on what like their bosses basically tell them to. So right now, you tell me one analyst on there that actually wants to create a real narrative behind NVIDIA. Is there any detractors on there that wants to do any fundamental research? Or are they just all following the same hopium?
Here's the thing. I've done the research on NVIDIA and the growth rates match up pretty well, and the profitability is insane at a 55% profit margin. For a hardware company, that's insane. For a SaaS company, that's insane. If these analysts are even remotely right, that means this year they do over 100 billion in net income. Next year they do around 140, 150 billion. And then the following year, they're going to do around 160, 170. So That's a lot of buybacks that are going to pump the EPS.
All I'm saying is I think the objectivity of a lot of these analysts has gone into like basically it's like 2000. If you guys remember 2008, how the credit rating agencies were distorting real underlying fundamentals of mortgage-backed securities, where they're saying, "Oh, this is a AAA security. Why?" And remember that blind lady that was like, "It's like, oh, because I have a boss. That's why." It's kind of the same thing. All these investment banks, what are they looking for? They're looking for business with all of these clients, right? They all want business. So if you give a negative rating, what do you think happens to the company? The company says, I'm not doing business with you. And all the banks lose money. So they're like, don't rate this thing what it's supposed to be. So I don't think a lot of them are willing to challenge the narrative. So
we'll see what they come out with. So here's what we're going to do. They have the revenue estimate for this year at $207.8 billion. I'm going to write it down. Let's see what Jensen guides for on Wednesday.
Okay.
Yeah, 207.
See,
so
like
right
that's the other thing too. Like, I don't understand how the analysts are in the brains of Sundar, Satya, Zuck, and Ellison and saying, I think Ellison is going to spend X amount of money in 2028. Like what are they, mind readers? Do they like, how do they know? Like, how are they trying to even get a demand picture together? They all quote the same exact like studies saying, and it's like McKinsey thinks that there's going to be 50% demand year over year. And they'll model their targets based on that one McKinsey study. So of course you're going to get real distortion saying everything is going to be in one specific target.
All right. So here are the numbers. Jesus Christ.
Sorry, I know you got to go to sleep, man.
No, it's fine. This is fucking crazy. Hold on.
Yeah, like Chris, the analyst in the late 1990s. Where were all the positive and tech bubble? Yeah, where were all of them? What happened? None of them could see this tech bubble. I'm telling you, man. I'm not saying that analysts are not worth it, but for a lot of businesses, especially the ones that are very popular in media, not one of them has the balls and the cojones to challenge the narrative. And you got to give it up to the people who don't think like that. Like, look at Dan Ives. I thought Dan Ives was an idiot. Look at what happened to Palantir. Palantir blew through Dan. Like when Dan said, I think Palantir is $120 stock, I was like, this fucking retard over here with this fruity ass shirt. You know?
You and freaking Ken.
What? Because we use the R word? I'm sorry, okay?
No,
I just grew up using the R word.
Ken doesn't like Dan Ives because of the way he freaking dresses. It's crazy.
Yeah, I don't like it. He's like I don't know. It's not that I don't like the way he dresses. I don't particularly care, but it's just a feature about him. Like, bro, like you're supposed to look like a professional. Like, imagine right now some idiot came on with like a do-rag and you're telling me like, yeah, man, I think NVIDIA is going to grow 50% year over year.
So here's where they were Q1, 44 billion. They did 46.7 in Q2. They're expected to do 54 billion in Q3. So that's 144 billion. The analysts have them at 207 billion. If that's correct, that means that they should do or guide for 63 billion in Q4. Mm-hmm. If that's true, they did 39.3 billion in Q4 2024, which means that it's going to be 60% year-over-year growth next quarter.
Here's a question: What if it ends up being 59%?
To me, as long as it's over 50%, who gives a fuck? But this is like because of how big they are. This is crazy.
But what if it's only 40%? Then what?
40%. This goes back to 140.
What if it's only 20%? Then it's like this dumbest thing where people are trying to figure out.
I'm not disagreeing, but this is still tremendous growth. Tremendous growth.
I'm not disagreeing with you. I am not disagreeing with you. I think you're absolutely right. But the thing is, the stock price is also a value of how much they end up allocating towards different things like share buybacks and everything else. And I think that's
Right.
where a lot of the analysts. I was looking at this report on some of the companies I'm investing in by just looking at the price targets that they have, and then also what their revenue expectations are. But the one thing that I can't believe that none of them adjusted was the debt. Like none of them took their debt into consideration. None of them took their share count into consideration. None of them took into account what the end share price would be, because they end up just thinking too much like, hey, I need to predict the future, so I'm just going to go with X, Y, and Z number. But if you start thinking like a CFO, you'll beat the market. I think more people should be following the CFOs and less on the CEOs, because CFOs actually know what the hell they're looking at from a share price perspective, and like how to allocate the capital to get the best shareholder returns. Like the CEO's job is the direction of the CEO's job is to direct the company into the right direction, but it's the CFO's job to make sure that the money goes in the right places and the spending happens in the right locations, and how to allocate capital towards debt, how to allocate capital towards equity buybacks and everything else. So I don't know. But as far as I'm concerned, what are you saying, that like the growth rate of NVIDIA is going to be like 60% next quarter?
If they guide for this, Q4 year over year will be 60%.
I mean, last quarter they grew at 55%. They went from 93, 77, 69 to 55.
I just think that you're going to see a massive drop off is what I'm saying. So I think the growth is amazing now. It's still going to be amazing next year, but I have a hard time thinking they get past 40% next year. I think it's going to be more like 35%.
Okay, so then what do you think the stock price is going to be if that's the case?
So I actually think NVIDIA is priced for perfection here. This was my end of year target, 185.
Which you hit.
Which I hit, but I did not think NVIDIA was getting past 200 this year. Like my end of year that I was going to finish, I was 185. And looking at the way other companies are valued, I think that NVIDIA can go up over time, but I don't think it deserves to be 220 this year. I think 185 is where it deserves to be.
So you think it's fair value? Which is basically what you just agreed with me. You just said, hey, it's not really overvalued, it's not undervalued, it's right where it's supposed to be.
I think it's fair value right now, but I do think there's a lot of upside momentum based on how much revenue growth they have with the amount of buybacks they're going to do.
You know who agrees with you right now?
Who? I swear to God, he does that once a night. He hits fucking exit stream once a night instead of hitting share screen. It is fucking hilarious. Now he'll be back in a sec. He does it all the time. I don't know why futures are tanking. Listen, it's not a stream unless Chris hits freaking exit.
I know. SoftBank dumped all of their shares.
Oh, I know SoftBank dumped all their shares.
Peter Thiel sold his entire position
I know he did.
in Tesla. I mean, not Tesla, sorry, in NVIDIA.
Yep.
Who are the other super investors that unloaded on them as this 13F cycle?
When Gerstner starts selling, I'll get worried. How about that?
I think Druckenmiller sold some too. Let me see. Hold on one second. Make sure I'm closing the right window. Okay, there we go.
And am I eating cookies? Once we're done, I am eating cookies. They're in the next room. They're not in arm's reach right now.
Tepper reduced it a few years ago. Who are the buyers? Pollen Capital, Dan Loeb bought a little bit. Kahn Brothers, David Tepper bought a little bit last quarter. Q2.
By the way, everyone,
Mhm.
Chris does phenomenal analysis. Here's his X. Please go follow him. He puts out a lot of really good posts pretty much every day.
Not really.
So,
I've been trying to cut back on trying to put good posts out.
well, you've been putting some good posts out, so I would definitely go follow Chris, everyone.
I appreciate the alley-oop. But look at this. I don't know. I don't see NVIDIA being like, oh my God, the greatest value ever at 180.
I wouldn't be buying here by any means. Like, you might gotta remember, my average is like 105 or so.
Yeah.
Like, I think Alphabet, Meta, Amazon, and Microsoft are better values right now.
Yeah.
Especially Meta. Meta at 1.5 trillion is a disgrace.
Say again.
So,
Sorry.
Meta at 1.5 trillion is a disgrace. It's just ridiculous.
I mean, this is the market's way of reminding Meta and Zuck. There's no just, hey, I'm gonna spend money into the ground. You know, the market has a way of telling CEOs what they really think, right? So this is the market reminding Zuck.
It's over. It's over.
What's over?
The memes
What
are
is
coming. It's
What
over.
memes?
Oh, the memes are over. You're gonna love this. This is how we're gonna end it. You ready?
Yeah.
Hold on. The memes are over.
Is it people coming after Tom
Dude.
Lee now all of a sudden?
You ready for what the next one is?
Okay.
Somebody's looking at their portfolio.
Mm-hmm. Save us, Jensen. Who can be your only hope?
This is the internet never fucking fails.
All right. So before we go, I know we were
Never
supposed
fails.
to. Yeah. Someone's like, I know, Chris, he sold at Palantir at 6. Actually, I sold at 10. You know, so haha. No, I think my fault was I never got back into Palantir. Not that I sold. Shit, I sell shit all the time that goes up 10x. The question is, do I get back into them? No, that's the problem.
Look, Palantir is a freak company that broke all the rules the way Tesla did. I was very bullish on Palantir and went neutral after it got to like 50 or 60 because I thought it was overvalued. I didn't sell, but I do have calls against some of the position. Now, Palantir's, my opinion, grossly overvalued. But
yeah,
that's neither here nor there. And remember, Chris it's not like he lost money. He made money on it. So you can't get mad at making a profit.
The other thing is I wouldn't say bad information, but I got information about the company that I did not like, which was basically that the AIPs, like the product foundry, is dog shit. Like I said, I've always said it. The information that I got apparently was wrong, where people actually do like foundry and they were able to sell their products. I mean, because the thing is, like, there's a lot of things that you can embellish, right? You can say that we have the greatest product in the world, but you can't embellish cash flow. There's a ton of companies that are buying this product. So even if someone is telling me the product is dog shit, that's not what the cash flow is saying. And at the end of the day, what does money do? Money talks, right? So
look at Salesforce. Everybody says they hate the Salesforce product, yet Salesforce is a cash flow machine. They keep growing. So
yeah, it's like when
sucks, but
I don't want to call people out, but Roy, I'm going to call out Roy on this and just say that was one of the dumbest comments that I've seen Roy make, in that Salesforce the product is garbage. I'm like, yeah, that's why almost every Fortune 500 company uses Salesforce, right? Because it's a dog shit product.
Everybody is entitled to their own opinion. The bottom line is that for me, and I actually just checked, I'm about even on Salesforce right now.
Yeah.
I would rather look at the numbers and the forward projections than take individual opinions. A lot of people do not like Salesforce, but they're not the decision makers in their company about if they're going to use Salesforce. There's a big difference.
Yeah. Yep.
And sometimes that gets mixed with market sentiment. So,
Yeah.
all right.
This is not shots fired at Crossroads. By the way, I like Roy. Okay, we're friends. Don't try to make it something that it's not. But the point is, when someone speaks about a product, I would say take it with a grain of salt because they might be putting their own biases into it. Just like the people that I spoke to about Palantir, they put their own biases into the conversation. And that's what tilted me away from believing in the core product, even though the amount of research that I did in the company was like hours on hours. Like, I don't know if you know this, Stephen. I was the one before Karp met Zelensky. I said that, look, Palantir is actually involved in Ukraine.
Yeah, you were saying that. Absolutely. Chris, answer this real quick and then I'm going to kill the stream.
Any idea about Webull? It's been tanking. All the brokers have been tanking. So it's not just Webull. And the thing is, Webull is at the bottom of the stack. Their growth rate is not as high as Robinhood. But I think the core product is good. And I think we'll know more about Webull in 2020. Well, not 2020, like in the next few weeks. So let me just show something.
Yeah, I mean, Hood's down 12% in 5 days. So the entire market's tanking, guys.
Yeah, so it's hard to say like one company that. So a lot of times the starting points can be different. There is a very loyal Webull base that I think that I think can support this. Their growth in international markets is still pretty good. So this is where I think this company is where Robinhood was a really, really long time ago, which is like 3 years ago, where Robinhood was like, $6, $7. And then eventually Robinhood kind of went up. Webull, I don't necessarily think has that same growth trajectory because they don't really have a Vlad Tenev like CEO who's like super how do I describe it? Who's like just really good at selling the product to the end user. I think Webull has a great product, but I think the guy at the top is not as charismatic as Vlad is. So there are some people who are really good at building and some people who are really, really good at promoting. I think the product that Webull has is really good, but unless the general market figures that out, it's not really going to do much, right? So that's why, like, if people really utilize Webull, like they would understand what the value is in it. But once again, it's not like you as the end user, because then you're going to carry your own biases into the conversation. It's what does everyone else think? And from the research that I've done, there are enough people who do like Webull. So, I don't even know who the guy at the top of Webull is. Yeah, that's right.
All right.
Chris Camillo put Hood to $1 trillion path. See, that's the one thing I agree with. I think I think Robinhood does get to $1 trillion eventually. Because I think...
All right, before I end, I'm going to ask you, when you say eventually, please tell me you do not mean in 5 or 10 years.
No, in 5 or 10 years. Yeah, I think it'll get there.
You realize JP Morgan is an $800 billion company, right?
Yeah.
Okay.
The reason why I'm saying it is because they have two forms of growth right now, Stephen. One, you've got this vertical of more and more and more people investing, not just in the US, but all around the world. Okay. So as more people start to put money in the markets and everything else, that's one growth vertical that's there. JP Morgan, one of the things that it's been able to do is that it has an iron fortress of a balance sheet. Robinhood is working on doing its banking and everything else. So it's not only expanding its total user base, but it's going into the super app like verticals mode. And there's a lot of what's it called? There's a lot of
50x their revenue to match JP Morgan's. I just don't know if they're 50x in their revenue.
But it's not a Steven, I can't believe you just said that, man. It's
course
not
I
about
just-
revenue. It's not about revenue.
Oh, I'm giving them the benefit of the doubt. Don't say net interest income.
What? No, not what is okay. What is JP Morgan's net profit margin?
Hold, I'd have to do the math. Give me a sec.
What is their growth rate and what is their net profit margin? And then lay that on top of Robinhood. Tell me which one has a better net profit margin and which one is growing their
Why
net
am I
profit
going
margin.
for a piece of paper? I have a fucking spreadsheet open. Hold on. So JP Morgan did 167 billion in revenue. Net profit was 58 billion.
No, net profit margin, not
I'm giving you the margin. The margin's 34.7%.
okay. Now what is Robinhood?
I can't do the math in my head, so sorry.
Okay, well let me see if I can bring it up. 1 second.
Net income. Yeah, Hood's profit margin is 52.19%. JP Morgan's is 34.7.
And which one is and what's the growth rate on JP Morgan versus growth rate on Robinhood?
I have no idea. It's obviously going to be higher on Hood. There's no question.
Right.
About that.
So then Hood gets a bigger multiple, right? In which case now the market cap is going to reflect that. I mean, to me, it's simple, but I do think that Robinhood could get re-rated down, of course, because that is how growth works, right? When you're high growth, everyone gives you a great multiple. When you're low growth, everyone gives you a shitty multiple. I think that right now, Robinhood has the ability to compound its growth for a much, much longer time period than JP Morgan can. And not to mention, there are a lot of things that JP Morgan does from a business model standpoint that puts risk on them, even though they are the best risk takers on the market in terms of the bank, right? With Robinhood, it's a purely transactional business. More transaction equals more revenue, more scaling.
Look, when it comes down to it, I'm looking at the profitability. I think Hood's going to be a great business, and I think they're in the right place at the right time because you're going to have the biggest wealth transfer over the next decade. And I do believe a lot of assets will end up on Hood and SoFi and Webull's platforms, public, et cetera, et cetera. I'm just have a hard time believing they're going to get that big, but we'll see.
Yeah.
Their margins are amazing. They're absolutely phenomenal. There's no question about that.
Yeah.
All
I'm
right.
telling you, this is one of those things, man. And the thing is, if their CEO wasn't as dynamic, I wouldn't believe it. But no, I think
Vlad's
over time,
a killer. Vlad's a killer. He's fucking great.
I mean, look at this. Look at this. Like, what is it called? Can you share my screen? Let me see. This is the wrong screen. Sorry. Let me just stop this. Share.
LOL. If Chris is right, Mitt will be the richest YouTuber. That's fucking great.
Oh, I'm in the wrong thing. That's why. Here we go. Okay, so fiscal AI. Let me do ExxonMobil. This is gone. So let's do Hood, Robinhood Markets, JP Morgan. Okay, so here's Robinhood. Here's JP Morgan, and here's Robinhood. I'm going to get rid of total revenues. Gonna do by company, and right here, look at their operating profit. Damn it. Let me see. Reset. Robinhood, JP Morgan. Here we go.
What did Burry just fucking tweet? Don't do this to me. I don't even know what this company is. Molina. I've never even heard of it.
Molina is a Medicaid insurer. Like they do primarily Medicaid insurance. They're an insurance company.
Great.
Yeah. This is Robinhood's operating margin. Okay. Look at this. It's at 45, 46, 47% in one direction. Do I think this, of course, levels off? Yeah, absolutely. It's going to level off. But when you have this cycle like this, and then at the same time, if you look at revenue I'll post this out somewhere. Let me see. I just want to get the margins, man. I'm still learning how to utilize this thing, but I don't want to see total revenues. I want to see revenue growth rate. Whatever. Look at this growth. Not only is revenues accelerating in one direction, but then you have the operating margin going in one direction, and they've been able to maintain their cost very well. So if you look at S&M, sales and market, no, not sales and marketing. Let's see, income statement, SG&A. Look at their SG&A growth, barely anything. This is JP Morgan's SG&A. I don't want to see JP. Fiscal AI, whatever. I'll figure this out eventually. I'll publish this. Fiscal AI has this great comparison tool, but sometimes, like if you're trying to compare two different businesses, it could not necessarily compare correctly. But have you used Fiscal AI yet?
No, just you and freaking Tanner use it.
I think it's great, man. I love it. I that's how I keep a track of a lot of businesses and their fundamentals and look for, from a valuation standpoint, what's actually happening. So like right now, this is like my TFC one. This is like book value per share is like $50. This is where you wanted to buy. This is not where you want to buy because there's not a lot of upside here, you know? So for a lot of banks trade at tangible book. So whenever you see tangible books drop like crazy, great times to buy a bank. So you can see here TFC's tangible book in 2020 was 52. This thing went down to 32. Eventually it catches up to its tangible book. That's when you want to kind of sell. And then tangible book drops down to 30 in March. You buy it again and look, it gets back. So tangible book hasn't been growing that much, but the share price always catches up nicely. So here, this is when we bought TFC. So someone was asking me on my Patreon, Chris, how do you know what the exit and entry price is on your stocks? You just got to know how to value a company long term. And if you figure that out, you know what a good entry and exit price is, and you can structure your options based on that. So magic. Like what's JP Morgan's tangible book?
I don't even remember, 100 something.
Let's see. Tangible book value for JP Morgan. And let me get rid of
It's 116. I'm sorry, 120. Tangible is 104.
128.
No, its book value is 124. Tangible is 104.
You're right. This one is book value is 128 and it's trading at 300, which means their operating margins are probably super high. Would you buy JP Morgan at this price?
Probably not.
Yeah. See, the best time to buy was here, but
I was very big on Citigroup. That's the one I was really into since 40. I think the banks are no longer interesting unless you're looking for dividend.
Yeah, I agree.
All right. I gotta get going.
All right. Later, dude.
I will see everybody later. Thank you for coming. Please go follow Chris. I will be on tomorrow night. And
how often do you stream now, dude? I feel like
I'm trying to do it every day.
Every single day?
Trying to.
Jeez, man.
Dude,
right.
Work, Seeking Alpha, streaming. I'm trying to do 3 things at once. Know what I mean?
Does your wife still remember who you are?
Not really. But I'm still writing 5 articles.
As long as the money's coming in, right? As long as the money comes in. Who cares?
I mean, I wrote 3.5 articles over the weekend.
You are a very productive individual, sir.
I got home from work at 6:30 and went live at 8, I think. Went live at 8. Didn't write it all today. Tomorrow, I'm going to write for a little bit probably from 5:30 to 7 and then try to go live around 8 or so. We'll see how the writing goes. So,
See,
No, we don't
I
use
research.
freaking AI to rate. Sorry, everyone.
I just need to keep doing research. Like one of the things I've just been researching. Like this whole thing on Fiserv has got me interested. So I'm like heavily committing time to researching Fiserv, heavily committed to researching Ethereum. So now I'm battle testing everything that Tom Lee is saying about Ethereum and about how there's long-term value there. And so I'm trying to be very analytical and trying to understand. See, I just don't know how he's getting to their price targets. That's the only thing. Because the thing is, I know his like, 7,500. I don't know how he gets to 7,500. I do see the upside in Ethereum. I just don't see like the exact price target, how you get there mathematically.
Couldn't tell you. But
Yeah.
all right. Thank you, everyone. See you later.
This is me trying to draw Steven longer and longer just to see how much I can push